Wacky. That was fun. I don't know about you guys, but my charts went absolutely bonkers for a little bit. Let's watch this. Let me pull up. Let's find the 8:30 timestamp. And let's run it out to the 8:30 timestamp, right? So there was the beginning of news right off of Fibonacci support. Uh-oh. No sound? Is it, guys, do you guys have me? Give me a Y if you can hear me, please. All right, thanks, guys. Cool. We'll get Jen to do the old reboot. Must be a London thing. Guys, I want you to see something freaking amazing. I didn't even know this was going to happen, to be honest with you. This wasn't premeditated. Look at where price started right at the news release. And look at where price ended to the tick right at the news release. I have to take this picture from my brother because about twice a week, he's like, I wrote this thing and it still amazes me. Even during chaotic news release, it went from fib to fib, guys. And here's the cool thing. Here's the cool thing is you guys knew exactly where these fibs were. And if this isn't a lesson in trusting your fibs and respecting your rules, and guys, it was too fast to trade right then. And NASDAQ did the same thing, didn't it, Andy? Guys, the patterns are so effective. And I'm going to sound like I'm bragging here, and I probably am a little bit because I am proud of my brother. The patterns are so effective that all you have to do is learn how to use them. All you have to do is learn a couple simple rules, and you'll be able to take advantage of this insanely accurate information. And that's what we're going to do for this first hour. But before we do it, guys, I want to talk about news a lot today. Not a lot, but more than usual. At 8:30 a.m., you guys saw the market absolutely scramble. That entire picture that I posted, that whole move up, was in probably 30 seconds. High impact news can make the market untradeable. High impact news can make it spike and jump. Jonathan, I noticed you posted in the other room, you're like, I think my software broke. Well, you took a trade directly in the news. And your software was trying to calculate not only the insane amount of ticks that were going on with the reaction to news, but also is trying to go through your stops and targets and all that stuff. And it did. It knocked your triggers out of whack a little bit. You just have to reload historical data. Guys, that was 8:30 a.m. It's done. It's in the mirror. We're good. At 10:30 a.m., if you're a crude trader, we have crude oil inventories. And again, I say it all the time. We're not, hey, JW, I'm not anyway, trading news. I don't trade what news says. I don't care how many barrels are in reserve. It doesn't matter to me. But what I do know, without a question, is that news can make the market react crazy. My record so far is I was slipped $1,400 on an FOMC release that I forgot about. I forgot to set a timer for. $1,400 against me, beyond my normal target. So I had a $240 stop. My entire loss was $1,640, and it happened in a fraction of a second. And it was so fast that it was just sad. I looked at it and I laughed, and I was like, oh man, rookie mistake. So guys, I'm checking news every day. We have that same FOMC going on at 2 o'clock today. If you're not setting a timer right now, you're doing yourself a huge disservice. Crude oil inventories at 10:30, even though it's low impact, it can very much make crude oil go pretty crazy. Most of our traders choose not to trade into crude oil inventories because there's usually somebody waiting to do something, right? There are no mulligans in trading. You know what, Rob? What's kind of cool is I lost that $1,600 on that trade, and I was back up $2,000 inside of 30 minutes because even when the market's moving fast, the patterns tend to work. It was just a minor setback. It didn't ruin my day. It didn't change my plan. It just made me go, crap, I got to dig out of this hole. And I did. So it was all good. And 2 o'clock, guys, 2:30. It's going to go nuts. It's going to go absolutely nuts. I'm going to tell you guys right now, I'm going to be somewhere else. I won't even have my software open. So we're going to do that every day. Check-in news each and every morning. Did I put the link in the room? I don't remember if I did. Let me put it in the room for you guys. I put just a little story in there, guys. Everybody in the room knows because I flap my gums a lot. I'm trying to get better at golf all the time. Isn't that crazy, Jonathan? I try to get better at golf all the time, guys. And just like trading, in the beginning, I was hunting birdies, right? I was hunting eagles. I wanted to be a great golfer, but I didn't want to put any time into it. I didn't want to focus on the mechanics that it took to be a good golfer. I was watching a Lee Trevino video the other day. If you guys don't know who Lou, yeah, I am. Can you guys not hear me? Can you give me a Y, guys, if you hear me? So we got a couple. So it's not on my end. Has to be time for a reboot. Guys, I'll do it again on my end. So I'm going to go, hold on, let me type it in there. I'm going to full clean, kick you all out. Please come back. All right. Bye, guys. Oops, sorry, YouTube. I just sniffed in your ear. My bad. So for those of you watching YouTube, we're having a minor technical difficulty here in Discord, but it should be back in just a second. For whatever reason, Discord gets a little wonky in the morning. Can you guys hear me? We good? I was talking to the YouTube people. I was like, sorry, YouTube people. All right, that's as cleaned out as I can get, guys. So this Lee Trevino story, I'll tell it while people are getting back in. He was talking about one of the biggest challenges for new golfers is just contact with the ball. And it's just funny. It's a little ball sitting there doing nothing, and it's hard as hell to hit. And he goes, everybody's worried about where the ball is going, and they're not worried about making contact. He goes, so go to the driving range and just focus on contact. Don't worry about where it's going. Just learn to hit it well, and then it'll be easy to aim. And I was thinking, because I find so many parallels between golfing, my golfing journey and my trading journey. And if you come into trading and you're focused only on the money, where's the money? Where's the money? How am I going to get paid? The market went up, the market went down. Where was my money in there? Guys, you're going to chase things that become unattainable. But if you focus on the mechanics, if you focus on the patterns, the rules, the process that yields the results, it's very much one of those you're teaching yourself to fish rather than just expecting to be handed a fish. And this is one of the big things about trading, guys, is every move in the market, and Steve, this is kind of related to your picture. Good morning, John C. Every move in the market isn't my move. Every time it goes up, it doesn't mean that there was a trade setup. Every time it goes down, it doesn't mean that there was or that I missed an entry. What I teach every day and what I talk about every day, guys, are very specific patterns that have been tested and they have been verified to win more than they lose. They have been proven through study, through research, through pictures, through simulation, through live trading, to win more than they lose, and that creates a statistical advantage. How he only like 54, he only won 54% of the points. That's it. You win 51% of the points. You win, right? It's kind of crazy. And guys, the futures markets trade billions of dollars an hour. And you think, and I think in the beginning, that I deserve every one of them. And Rob, this one's for you. My brother used to say that if you walk into a bank and you say, give me all the money, guys, you're a bank robber and you're going to get tased and hogtied and hauled off to federal prison. But if you walk into the bank and you say, give me my money, please, give me the money that I earned, give me the money that I worked for, then you're going to walk out and you're a customer. And day trading is very much like that, guys. There's going to be, I'm just going to do it real quick. There's going to be all of this movement, right? All of this movement happens in the market. This market goes up, it goes down, it goes up, it goes down. And the reality is that if I catch this little snippet of it right there on that day, and this little snippet there, and there, and there, and there, in between the trouble, when my rules are met, guys, I can make 6 figures, 7 figures a year by catching the best moves instead of chasing all the moves. So what we're going to do today, something completely different, is we're going to talk about the best moves. We're going to talk about the high probability trend trade. We're going to talk about a trade that typically wins 70 to 80% of the time. Little spoiler alert, it's boring. Being successful is boring, right? Being successful isn't exciting. Guys, you're not sitting in the front seat of a Ferrari with a model on either arm while you're day trading. You're sitting in a room and you're just patiently waiting for your advantages to come to play. So we're going to talk about the easiest one to catch, guys. We're going to talk about the trade that typically wins 70 to 80% of the time. We're going to talk about the trade that is going to instill in you confidence and trust in the software and the methodology. And this is going to be a high probability trend trade. And a high probability trend trade is defined is when each indicator on every chart agrees for the rules for the trade, guys. And typically this is when your triggers are the strongest, when there's no termination conditions in the way. It wouldn't open for like 20 minutes. If that ever happens, Morgan, like mine spun for 3 minutes, I go to Task Manager and I just kill it. And then I come back in and it usually works. And I don't know why it does that. Kill it with the Task Man. Guys, this high probability trend trade is designed to be your foundation trade. It's designed to be your stepping stone. And what it does for you is it teaches you to read your indicators. And gosh, we've been seeing it this week already. That when you can read your indicators, guys, and that's 90% of your day. 90% of your day is doing absolutely nothing. And that kind of goes back to the whole, every move isn't your move, guys. Every dollar isn't your dollar. Every tick isn't your tick. Your job is to make money. Your job is to win more than you lose. Your job is to get in and get the hell out when your advantages are gone. So you've got to learn to recognize advantages. That's what the high probability trend trade does for you. It teaches you to read your indicators. It teaches you patience, to sit on your hands, to wait for those advantages to come together. And that 90% of the day is waiting for advantages. 10% will be having the trust in your methodology to pull the trigger when your rules are met and to do it without opinion, right? To do it without fear, to do it without really even wishing or hoping, because you know, because you studied it, that if you trade this trade 100 times, you're probably going to win 70 to 80, and you're probably going to lose 20 to 30. And you become okay with the idea that it's okay to not win every trade, and you become okay with the idea that you don't have to catch every tick, just catch the best ticks. Hit your goals and go live life. So once you're good at reading your charts, guys, once you're into this high probability trend trade, once you can get that recognition of advantages, you will understand where the market is likely to continue, and you're going to use that for entries. You're going to understand where the market is likely to go, and that's going to help you with intelligent profits. And then you're also going to understand where the market is likely to stop. And this likely to stop area is what we call a termination condition. And a termination condition is this big screaming voice in your head that says anything into this line is not my money. I'm going to sit on my hands. Hey, good morning, Kenan. So we're going to go through this, guys. We're going to focus on the high probability trend trade. This trade is 3 rules. That's it, 3 rules. I really need you to get good at 2 things. I'm telling you, guys, within the first 3 or 4 days, if you stay focused, you're going to understand how to recognize momentum, and you're going to understand how to recognize a clear path. None of those termination conditions in your way. This is the foundation for almost every trading plan that I've ever seen. If you are good at momentum and understanding termination conditions, you're going to find a way to get paid. These 3 rules, guys, this is what I want you speaking to yourself every day. I want you not saying, is it a long trade, but rather, do I have momentum because of strong triggers? Rule number 1. Do I have a clear path because of no termination conditions? Rule number 2. Initially, it's, do I have an entry area because of the rules being met? Rule number 3. And if I have momentum, a clear path, and an entry area, well, then I have a trade. These 3 rules, these 3 advantages are going to happen on only 2 charts, guys. You're going to use the most current bar on a large chart, and it's going to define the direction of the market. If the background is red, the market's going down. Go with it. And if the background is green, it's going up. It's going to define the momentum of the market. That's rule number 1. Giving you the advantage of a market that's likely to continue in the direction of the trend. And you're also going to understand the areas, whether they're problematic, whether they have the potential to break, whether they've broken. And that's going to be rule number 2, guys. And all of this happens in 1 bar on the large chart. It'll happen on the most current bar. I took a little historical snippet here because rule number 3 happens on a small chart. And the small chart is where we're going to take an X-ray of that 1 bar. And you're going to see 15 to 30 bars. And rule number 3 says that you're going to buy or sell a pullback. We're going to use this little internal movement of this bar, and you're going to sell a pullback at Fibonacci resistance, or you're going to buy a pullback at Fibonacci support. And by using this refinement chart, guys, you're going to be able to pinpoint where the market is most likely to continue. It will allow you to reduce your risk. It's going to allow you to maximize your profit potential. And we use these 2 charts because they're a reflection of the 2 groups in the market, if you will. There is the large crowd. These are the movers and the shakers. These guys have the money. These ladies have the money. These people, if you will. And they are going to create those trends, and they are going to create that momentum, and they will react to those key areas, guys. When I talk about the large chart, and I talk about the large crowd reacting to areas, guys, there it is right there. Straight off of Fibonacci support all the way to Fibonacci resistance, and that is the exact number where this market stopped going up. That's the large crowd in control, guys. They're making this happen. When they're telling us that the rules are met, we're going to use a smaller, faster chart. We're going to let them push back. We're going to refine that. And we're going to take advantage of everything that the large crowd is making happen. And we're going to do it because there's a small crowd that's not afraid to fight. Guys, the small crowd is still 100 times larger than you will ever be. So we don't fight, we go with. We just wait for them right there. And that's where rule number 3 is going to pinpoint, guys. Again, the large crowd is this guy. They're apex predators. They have everything they need to do whatever the hell they want. We're going to be remoras. We're going to let them establish trends and momentum. We're going to get away from the areas they react to, and we're going to get ours. We don't have to be in every move. We just have to be in the best moves. So, with that being said, here comes broken record time, guys. How are you going to get to where you want to be? Are you going to become a professional golfer by watching videos? Hell no. Are you going to be able to play tennis like the pros if you're watching videos? No. Are you going to be a great chess player watching chess on TV? No. Guys, you got to get in. You got to get dirty. You got to do some work. You got to commit to learning the rules. You got to commit to understanding the software. And I'm going to tell you right now, and I'm going to say it, I'm feeling a little preachy this morning. You will get out of this software exactly what you put into it. So if your study habits are half-assed, you're probably going to get half-assed results, right? If your study habits are unfocused, if they're all over the place, that's probably how your trading is going to be. So let me show you how to become a confident trader ASAP, guys. Post in the room. Post your pictures. Every trade that you take, post it in the room. Every time you look at a line and you don't know what that line is, post it in the room with a question. Every time you post in the room, though, you have to tell me what your chart read is. So if you're looking at your chart and you say, Mark, I'm in an uptrend with this bright red background, it opens the door for a lesson on direction. If you say that I have strength and triggers and you don't, it opens the door for a lesson on momentum. And the same is true on everything, whether it's entries, exits, clear path, momentum. Guys, every time you post in the room, you and I get to have a private session together. And my only goal is to help you read your indicators better, because when you can read your indicators, you can follow your rules. And when you can follow your rules, guys, you can have a statistical advantage each and every time you enter the market. You can have a pattern that wins more than it loses. That should be your goal every day. So post in the room, and then guys, take advantage of this spreadsheet. I post mine in the room every morning. Nexgen gave you one of these when you signed up for your demo, when you bought your software. Guys, there's even a link to it over here. If you want to start fresh, there's a link to the tracking sheet. I don't know why you would do that when I will give you mine, and mine's pretty thorough. You just have to add your section to it, guys. And the first tab is your trade journal. This is where you're going to post every trade that you take. You're going to post every winner because winners feel good, and you're going to post every loser because losers create lessons. Losers are the path to more winners, guys. Don't hide your losers. But you're not just going to post them in here and say, all right, I'm done, I did my part. Guys, you got to go back to it. So whatever you did yesterday, whatever feedback you received yesterday, whatever annotations you made yesterday, whatever trades you took yesterday, you should be looking at this morning, and you should be asking yourself what worked and what didn't work, right? Because now you're focused on the things that are bringing you success, and you're also focused on avoiding the things that are taking that success from you. You'll notice that you feel relaxed when you have advantages. You'll notice that things feel forced when you know you're breaking your rules, when you're trading risky. And if you take this little historical study every morning, pour a cup of coffee, check your news, look at your trades, right? It's going to set you up for the day, and it will accelerate the learning, guys. In a business where everything is patterns, the more patterns you can recognize, the easier it becomes. So there's the second tab, which is the 101 tab, and I'm going to give you a little drill on how to fill this one out. These are the rules of the high probability trend trade broken down. They're highlighted in green. Strong triggers, clear path, entry. In red, you have the opposite of your rules being true. If this is what it looks like to have a strong trigger, it's imperative that you understand what it looks like to have a weak trigger, so you don't confuse the two. Same thing with a clear path and a termination condition. You have to know the difference so that you don't confuse the two. And the entries, guys, you got to learn these looks so they become easy. So your job is to take a bajillion pictures and to fill up your section, which is blank. It's intentionally left blank so that you can get some work done, guys. You're going to fill out the 101 section, but you're also going to fill out this section. And when you have a picture of a trade with a statistical advantage, you're going to drop it into the green section. And what you're doing is you're creating your trading plan. As you learn to manage, that's the second piece of the puzzle. You're going to begin to take pictures of, you're like, man, I could have held that one longer. Let me annotate a chart wide. Let me drop it in here so that I can hold for bigger moves. Patterns that repeat themselves, termination conditions, and your goal is to make your section look like the one that I put together for you guys. And this is 350 plus pictures of you guys being absolutely brilliant with the software. This is the entry sequence, every step to finding the perfect entry for the high probability trend trade. There's a very mechanical management plan to help you remove emotion and fear and adrenaline and all that stuff from your management in the beginning. And then I've gone through, guys, and things, when to hold bigger, when to exit, where not to put your stops. Patterns that repeat themselves over and over and over. Tons of termination conditions here. And for some of you adrenaline junkies, guys, I get a lot of people that see people in the other room trading the NASDAQ, and they're like, well, I want to trade the NASDAQ. Guys, the NASDAQ is the angriest person that you have ever dated, and they've been drinking. The NASDAQ, if you don't know your rules, if you don't know your patterns inside of a couple seconds, the NASDAQ will absolutely chew you up and spit you out. So I teach on crude oil. I teach on S&P because those are the smoother of the two. Those are the ones that give you the ability and that little bit of reduction of speed so that you can find what you're looking for. So guys, I put my spreadsheet in there. Please take it, use it, fill it out. And then we're going to learn the rules for when it's okay to trade. We're going to talk extensively about each rule. We're going to break them down individually. We're going to tie them together to create a high probability trend trade. That trade that typically wins 70 to 80% of the time. Your job is to simulate, right? To practice. Traders are notorious for beating themselves up if they lose a trade. Traders are notorious for beating themselves up if they make a mistake. Guys, I'm telling you right now, I want you to make mistakes. And it sounds weird, right? He said he wants me to lose. That's what all of you heard. I do. I want you to lose on simulator. I want you to trade in determination conditions on simulator. I want you to break your rules because you have to know what it looks like to do it wrong, to embrace the idea that doing it right pays dividends. So if you're brand new with me here, we're keeping it simple. We're keeping it focused. Simulate, but get those pictures in the room. I'm not going to ridicule you. We're going to talk about advantages, and we're going to find a way to do it better. The people that post the most, these are the people that get to where they want to be. The people that post for a week or two and then fall off are the people that come back to me in 3 months and say, you know what, Mark, I've been screwing it up. I'm going to come back and try again. So don't stop. The room is your room, guys. Whether you've been with me for a month or a year, the room is your room. Post in, get feedback. I've been doing this a little over 4 years, and I learn something every day. My brother's been doing this for almost 30 years, and he'll tell you he learns something every day. Don't ever stop learning. But it takes pictures. It takes annotation. We're going to simplify. We're going to talk about a high probability trend trade. I'm also going to give you a plan for what we call a medium probability trend trade. And guys, the difference between the two, let's go back to the glossary of common terms. A high probability trend trade teaches you to read your indicators. Every indicator is going to agree. This is the trade, man, this is the money, this is the foundation, this is the base. Your ability to recognize the high probability trend trade will open the door for so many opportunities. So really dedicate yourself to this trade. Give it 30 days. Get good at it. Because once you're great at recognizing momentum and clear paths, and once you're picking out entry areas and you start to work through the management thing a little bit, medium probability trades are going to present themselves at every corner. And a medium probability trade means that most of your indicators line up for a trade. However, a small issue exists. Your ability to read your charts is going to have you identifying what that small issue is, and you're going to know how to take it on head first. Most of these trades will be managed assertively, which means that you have to recognize change quickly on a small chart. You have to be willing to take quick profits. You have to be willing to protect yourself, to get to break even. And you have to be willing to lose to win, guys. And medium probability trades aren't the trades that typically win 70 to 80% of the time. So let these medium probability trades be a supplement to your high probability trend trading. It is like a boxing match with craziness, right? So guys, we're going to talk about both. The easiest way to catch trades is to know what your trade looks like. To be able to associate a look with a rule. To know exactly what it takes to get you in and know exactly what it takes to get you out. And once you get to that point, and I'm telling you right now, keep it focused. I need 20 trading days of focused study. The looks become easy. And that's where, guys, I think I've done you a pretty good service here. If you click on 15 long trades, they're all going to look pretty much the same. If you click on 15 short trades, they're all going to look pretty much the same. So what you're doing is you're creating recognition, guys. And if you're not taking that spreadsheet and going through every freaking link on it and reading it and studying it, you're slowing yourself down. You're slowing down your forward progress, guys. Don't expect to be a great trader by taking trades. Expect to be a great trader by learning patterns. And that's what we're going to do. You've got to take pictures. You've got to understand so that they become easy. So let's make them easy, guys. 3 rules, 2 charts. 2 charts, big chart, little chart, large chart, most current bar, direction, momentum, and areas, first 2 rules. Small chart, entry chart. And just because the market went up does not mean that you had a trade. Just because the market went down does not mean that your rules are met. You've got to rely on your chart read, understanding advantages to know whether or not the rules were met, whether or not the statistical advantages were in place. So they all start with strong triggers, guys. Strong triggers on the large chart. Strong triggers set the tone, and there's a lot of trading plans that are built just around momentum. You're going to see probably a lot of it today. One of my favorite phrases in this room is momentum for the win. Momentum for the win. I love that phrase, guys. What does momentum look like on the large chart? When the background is green, when everything is going up, strong triggers means that my small triggers, these solid lines, and these dash triggers, which are my large triggers, small triggers, large triggers, they both have to be green too. Jonathan, if I don't get to your picture by 11:05 or so, let me know and I'll make sure that you get feedback before you split. When the background is green, when my triggers are green, and my small triggers are up and above the large triggers, and my large triggers are widening and angled in the direction of the trend, guys, it's the space between the small and the large that lets me know that I have strong triggers. When I have strong triggers, the odds are favorable for the market to continue up. When the odds are favorable for the market to continue up, ladies and gentlemen, you're going to use a refinement chart and you're going to buy Fibonacci support to go with that trend, to go with that momentum for the high probability trend trade. I need my laser printer here. On a large chart, on that single bar, it's going to look like a tail or a wick, whatever you want to call it, a black line, I don't care. You're going to pinpoint exactly where the bottom of that tail is most likely to form, and this will become your entry for the highest probability trend trade when the rules are met. When the background is red and the market's going down, guys, small triggers below the large triggers are wide. The space between the two lets me know that the odds are favorable for the market to continue down. You will be able to pinpoint using a smaller, faster chart where this tail is most likely to form. That's going to be your pullback to Fibonacci resistance inside of triggers. That's rule number 3, getting you into the market with the momentum, looking to cruise with it going down. So let's see if we can find an example or two of momentum, guys. That's a small chart. Let's find a big chart. There we go. Obviously, news kind of made it weird. But look at this. Separation between the small and the large, and it went right down to the area. It reversed. Separation between the small and the large, and it went right up to the area, guys. Strong triggers push the market. Strong triggers can break key areas. Look at those tails as the areas are breaking. Strong triggers can even cover up the mistakes that new users make, guys. So strong triggers, your job as a brand new user, watch this, we'll just use this one right here. From the middle of nowhere, not taking a trade, not worrying about anything, just taking a picture. And I'm going to draw an arrow right in that giant gap. And I'm going to say something clever, like strong triggers. But I'm not just going to stop at strong triggers. I'm going to say small above large, both triggers and the background are green, which means everything agrees, right? Say this is momentum. This is rule number 1 met. Is everybody comfortable with that? With the idea that that separation creates an advantage, that this is rule number 1. This is your advantage of momentum. This is the look that starts the process of finding a trade, guys. And momentum breaks areas. Momentum covers mistakes. Momentum is that advantage that I never want to do without. But momentum isn't the end-all be-all, guys. Momentum is just one part of it. When you have momentum, momentum is going to go away. And when the small triggers return back inside of the large triggers, that momentum is gone. That's a weakening of the large triggers, guys. And when you have weak large triggers, anything can happen up or down. So you brand new users, there's 2 scenarios. You either have that odds favorable momentum. You're going to hear that in class all day long. Or you have a weakness in the triggers. Your range, your little happy spot as a brand new user comes from the point of separation to the point of return. And this is where high probability trend trades happen. I'll give you guys this picture. You might want to put it into your spreadsheet. From the point of separation until the triggers return is where high probability trend trades happen. If there's not separation, it's not a high probability trend trade, guys. It might be weak triggers. But the better you get at reading indicators, you're going to start off selling Fibonacci resistance with odds favorable momentum. And then as those triggers begin to return, you're going to say to yourself, holy smokes, the trend is slowing. And when one small trigger works inside, but one stays outside, guys, there still might be opportunities to sell that resistance. But you have to use your chart reading to make sure that that everything lines up. You're no longer odds favorable momentum. You are now slowing momentum. And once they work inside, guys, you still might, as a chart reader, find an opportunity to take a short trade. And you're going to manage it aggressively because you're good at that now. But you're going to say to yourself, this could never, ever be a trade that typically wins 70 to 80% of the time because I don't have odds favorable momentum. You're going to learn to speak to yourself in terms of advantages because when you know what you're getting into, you know whether or not it needs to be managed aggressively. And guys, when these weak triggers smack into fibs, it's typically the end of the road. That's when we hit those termination conditions. That's when we reach those areas likely to stop the market. And that's rule number 2. And I'm going to do this one more time. I'm going to keep going back to the live market because I want you guys to see something. I want you to see where termination condition rules were met. And I'm doing this for a reason. I'm doing this because your job, as you grow at the software, is to be able to identify areas that may stop the market. Because this is going to be a giant red flag that says don't trade into it. And the cool thing is with a couple days of study, with just a couple days of study, you're going to be able to identify these areas that may stop the market, and you'll be able to make the amazing decision to not trade into them, to say to yourself, I no longer have a clear path. Termination conditions, when they're not present, means that you have room to your target. When you have room to your target, you have room to make money. We just call it a clear path. So what you'll find is that when you couple momentum with a clear path, that market tends to scream in the direction that it's going. So we have to be able to identify it, guys. Termination conditions are lines on a large chart. That's the easiest way to say it. These are the areas where the people in charge are making decisions. These are the areas where the people that move the market are buying, where they're selling, where they're entering, where they're exiting, and sometimes even where they're fighting. And these lines can be blue Fibonacci support, it can be red Fibonacci resistance, yellow 1-to-1 dots, a cyan divergence low line, a magenta divergence high line. And guys, I'm going to give you just visually so that you can see it, so you know exactly what you're getting into. These are where decisions are made. We're going to use the trigger lines, the same trigger lines that created momentum, guys. We're going to use these lines and compare them to the areas, and you're going to know if they're likely to stop the market. That's your termination condition. You're going to know if they have the potential to break. That's going to throw you into a medium probability scenario. Or you're going to understand if they've broken and they're in your rear view mirror and you shouldn't even have to worry about it anymore. Lines on the large chart are where decisions are made. So, in order for the decision process to kick off, price must reach the area. Price reaches the area is the first part of the equation, guys. And when price reaches an area, there are 3 scenarios. The first scenario is that the trigger lines remain above support. When the trigger lines are still above the area, this area is a termination condition. It is not a clear path. It's either going to break, it's either going to reverse the market, or it's going to set off a fight that you don't want to be in the middle of. What I need everybody in this room to just go ahead and admit to themselves and write down on a piece of paper is that you have absolutely no idea what's going to happen. You will never have any idea what's going to happen. So we trade a pattern. We recognize a pattern that says, my clear path is gone. Price reaches the area, triggers remain above, no trades into that area. When your small triggers smash through the area, not without a large chart, Jonathan. Show me your large chart. When the large triggers remain above the area, but the small triggers smash through. With odds favorable momentum, guys, this is an area with the potential to break. This is the area where that odds favorable momentum has the potential to break it, but it's not broken yet. It's not a clear path. And therefore, it can never be a high probability trend trade. But I'm going to give you a rock solid plan to be able to capitalize on these areas with the potential to break. And then once the smalls and the large break through the area, now the area is broken. Now the path is clear. 50-50, exactly. No trade. I like this picture. I'm going to steal this one. I'm going to go drop this one into my 101. This is it 100%, Adriana. No triggers through, termination, no trade short, right? Smalls through, large not. 50% of my triggers are through, 50% are not. Medium probability trade needs to be managed aggressively. When both the small triggers and the large triggers are through, now if you have odds favorable momentum, if you have those entry rules, the path is clear and it is 100% high probability trend trade range. Anything that happens with these triggers below the area is a 100% clear path until you reach the next area. Does that make sense? So once small and large got below this area was clear. It's in the rearview mirror. But there's areas next ahead of it. So we have to go through the process every time we reach an area. It's a termination. It has the potential to break. It's broken. And go in the other direction. It's the exact same thing. This time we're using a divergence high line. Price reaches the divergence high line. The triggers remain below. Absolutely no trade. It's a termination condition. Rule number 2 isn't met. When the small triggers smash through with odds favorable momentum, like Adriana posted for you guys, 50% are through, 50% are not. This becomes a medium probability scenario because it has the potential to break, but it's not a clear path yet. But once the smalls and the large get to the other side of the area in question, guys, your path is clear until you reach the next area. For the brand new user, for the high probability trend trade, you either have a clear path or you don't. Let those be your two options. And once you get good at these, you will find a way to capitalize on that medium probability scenario. So price reaches a divergence high. Triggers remain below. It's a termination. I want to do a quick little lesson, guys. If you see a pivot, the market goes up and down and that magenta line prints off of it, it means that there was a loss of momentum. That's all it means. It's not a termination condition because the price must reach the area. That is always the rule. Here, price creates the area. Your software calculates that loss of momentum about 3 bars down. So this pink line wasn't even there until about all the way down here. But when price reaches it, the triggers remain below. Now it's a termination. If price trades above that pink line and back below, it's what we call a pivot stop out. You'll see it labeled PSO on charts. Resistance, triggers below, no longs, 1-to-1s, triggers below, no longs. And it just, the same thing going the other way, guys. Price reaches yellow 1-to-1s, triggers remain above. And look at the fight, right, between support and resistance. And then once they settle down, guys, there's that odds favorable and a clear path, and there's one of those tails. This is where you get paid. This is where you sit on your hands and do nothing. Support, even with odds favorable momentum. There's another one of those pivot stop outs. Guys, is everybody good with that idea? That when price reaches an area, this is the S&P. Price reaches the area, pushes it all the way to support, comes back to the area, creates an untradeable bounce, and now here in the moment, we're coming right up on Fibonacci resistance, guys. Pretty awesome, right? If you don't think these guys know where the key areas are, and if, guys, you know as well, you're going to learn how to take advantage of them. Price reach resistance. The triggers are below. Let's sit on our hands for a second and see what happens. That's the best course. So can you guys give me a why in the room? Areas on the large chart are problematic, or can be. Areas on the large chart are where decisions are made. Areas on the large chart are where termination conditions, that simple calculation, where are my trigger lines? The large chart is where that happens. The large chart is a slow chart. The large chart is a broad stroke of a brush. It's a slow moving train. The small chart has 15 to 30 bars inside of every bar on the large chart. So if there's some change happening on the large chart, you can see it on the small chart first. And there is one time on the small chart where I will say, I don't have a clear path. There is one time on a small chart where I'll say rule number 2 isn't met. And that's if 3 of those divergences print in the same price range. Guys, for the same price range, you're going to use the exact same recipe. Rob, it's only 9:46 a.m., brother. It's crude oil inventories day. You got people sitting on their hands waiting for a report right now in crude oil. Every Wednesday morning is typically a slow morning in crude oil. It's okay. There's other markets. 3 divergences in the same price range may terminate the trend. That's it. It may, it might, it could. It's not guaranteed. 3 divergences in the same price range with that rule number 1 lesson, weak anything can happen triggers, makes it more powerful. And then guys, if your final divergence is higher than the lowest or lower than the highest, creates a head and shoulder, it becomes more powerful still. This is the only time on a small chart I'm going to say, hey, I don't have a clear path. 3 divergences says that it's gone. I'm no longer in high probability range. When price reaches an area and the triggers remain below, you have to be patient, guys. And there was a 3-point knockdown there. You can't see it because it's just a large chart. But if you look at your small chart, you can see that they reacted to it almost instantly right at the area. Somebody knew that area was there. Somebody took a couple profits. And you guys see the reaction on that smaller, faster chart. So we have odds favorable momentum on the large chart, guys. We have a market that says it's likely to continue in the direction of the trend. We have a clear path on the large chart, which means that there's no termination conditions reached. So now it's time to go to that smaller chart. Pete, what a beautiful place to take profits. Pete, you sat in my classroom when I told you first thing in the morning that you would understand where the market was likely to go, didn't you? And it sounds like you believe it. What a great place to get paid. Guys, this is how you're going to use the software. Thanks for posting that, Pete. Now we're going to go to that smaller, faster chart. Now we're going to go to that refinement chart. Now we're going to go to that chart that says that you're going to use a limit order. You're going to pinpoint your entries so amazingly accurate that you're going to use a limit order to buy or sell a pullback, that little shove that the small crowd creates. And you're going to have that limit order waiting in an area. Fibs, midbands, and yellow 1-to-1s. Guys, areas on the large chart define termination conditions. Areas on the small chart are where we're going to look for our entries for the high probability trend trade because they give the market something to bounce off of. But here's the deal. We want those areas to be inside of triggers. Andy, do I need to check your picture for a question? Your large chart is all scrunched. So Andy, you squished it. You know, yeah, the action is so far out of range that there's just no fibs. You've gone so far because of news outside of the range. Yeah, no, that's good though. That all your fibs are in the rearview mirror. What does that mean? That means you've got to be pretty adamant about momentum and entry area, right? That's a pretty cool picture. I like that picture. So guys, rule number 3 is going to pinpoint your entries. Rule number 3 is going to happen when the large chart says up. The background is green. When the large chart has separation between the small and the large and the momentum is present, and when the large chart triggers have cleared resistance, it's now behaving as support and my path is clear. Can you guys give me a Y in the room if you're feeling saucy this morning? Do you see how the rules are met for the high probability trend trade? And guys, right at this point, when everything says look for an entry, it's right where my little laser pointer is. You're at the top of this bar. And you're saying to yourself, oh my gosh, they're going without me. I don't have a trade. This is horrible. I'm worried. The fear of missing out is gnawing at you. And then the small crowd shows up, guys, and they start the push. And this is the pattern. And this is why I say every move isn't your move, because sometimes the small crowd can't get anything done at all. Sometimes there's so much momentum that they just get run over. But if they give you that reversal bar, if they give you that shove, you guys are going to be able to pinpoint exactly where the market is most likely to continue. And that's at areas inside of triggers. And this area inside of triggers where the market continued up from is the bottom of the tail. So you can actually use these tails to go back and study. You can go back historically and circle a tail and see if it lines up and piece the two charts together. The rules say areas inside of triggers, guys. Areas inside of triggers. And I want to talk about why. And this is a lesson that I put together, and this is an epiphany that I had just a couple months ago, guys. There's large triggers on your large chart, guys. Triggers are moving averages. Price tends to come back to moving averages. That's the easy way to say it. Pete, let me go through entry lessons. I think we're going to answer your question. And if I don't answer it by the end of entries, you let me know and I will clarify. That's a good answer though, and we're going to talk about it. And now I get to be a little more detailed. Guys, large triggers on the large chart is where I expect the price on the large chart to return to. This is my correction point for the large chart. The large triggers on the small chart are where I expect price to correct to. This is my correction point on the small chart. This isn't my entry area because entries come from areas. But when the large chart correction point and the small chart correction point overlap, when they're one on top of the other, we call this favorable large triggers. Favorable large triggers is going to give you the smallest amount of space to shoehorn an area inside of. So when you have favorable large triggers, when your correction points are one on top of the other, you're going to use areas inside of those triggers and it's going to help you pinpoint your entry. But here's the deal. If your correction points are split, well, now you have 2 points where the market may correct to. If we're using areas inside, very often it's going to eliminate one of the options completely out of the equation. The only line inside of a trigger is up here in the higher correction point. And then sometimes those lines won't be inside of triggers, guys. And this is where understanding the language of the rule pays huge dividends. And we all learn this lesson eventually. When my correction points are spaced apart, when I don't have any lines inside of either trigger, there is no way that I could ever have rule number 3 met. There is no way that I could ever be looking for a high probability trend trade. So if my areas are stuck in between, guys, I'm going to have to use some chart reading to maybe find an entry, or I'm going to have to choose to not take an entry at all. So there's 2 looks, and I'm going to give you guys that one because that one's worth a read. There's 2 looks, guys. There's favorable large triggers. One on top of the other, 2 snakes riding piggyback, the smallest possible range where we expect price bars to come back to. This is where your advantage lies. Split triggers means that there's indecision, that you can't pinpoint exactly where the market's going to come to, guys. It's going to increase your risk. It's going to decrease your accuracy. For the brand new user, favorable large triggers is your best bet. So how do we pick an entry? How do you pick an entry? When everything says up, this one's for you, Pete. When everything says up, I'm going to wait for the small crowd to do their thing. That's the reversal bar, guys. The reversal bar signals the beginning of the pullback. I'm going to type this in all caps in the room. The reversal bar, I can't even spell it. The reversal bar is not your entry for the high probability trend trade. And I'm going to show you why real quick, because I see this as a recurring problem in the room. These small triggers are telling you that the momentum to the upside is absolutely screaming. And as long as bars are on the left side of those small triggers, that market's going to continue up. It's just, it's a moving average thing. This reversal bar puts price on the wrong side of those triggers, guys. And if you jump in right here, what you're saying is, oh, thank goodness I don't have momentum anymore. Let me get into the trade. The reversal bar is not your entry, guys. The reversal bar is the beginning of that pushback. So when you get a reversal bar, the first thing to do is to find those trigger lines, because this is where we expect those price bars to go to. I expect price to go back to those trigger lines. I don't expect trigger lines to stop price. I don't expect trigger lines to create a bounce. I don't expect trigger lines to do anything more than give me a very clear view of where these bars have the potential to come back to. So when the price bars hit the trigger lines, that is not your entry for the high probability trend trade. The rules say, and I want you to really start writing it on your charts, that my trade comes from an area inside of triggers. From an area, fibs, mid bands, or yellow 1-to-1s, and they have to be inside of those triggers. Doesn't matter if it's inside the large trigger, the synthetic trigger. Synthetic's a fancy way of saying the large trigger from the large chart. Doesn't matter. But the areas have to be inside of the triggers. Can everybody give me a Y in the room? Because this language is very important. Because this area is beyond the correction point. This area is beyond where I expect price to return to. I mean, Pete, it can be anything that you want, right? I'm not here to tell you how to trade. I'm here to teach you how to read indicators. But Pete, watch this. If this box represents where I expect the price bars to come back to, right? And this black box represents from the areas inside, from the high point to the low point. And this box is where the market is most likely to continue, because it incorporates not only the correction area, but also something to bounce off of. When these lines out here beyond the correction area, what you're saying is, if you put an order down here, you're saying, I hope that all of my rules get broken and the market accelerates beyond it. And Pete, what you're going to do is you're going to learn to put stops down there. That's not a stop. That's a big lovey face. That was for you, Steve, when I saw your language change. So when we're picking entries, Pete, from the highest point of support to the lowest point of support inside of triggers, all bolds, this blue box represents where the market is most likely to bounce, to continue with the odds favorable momentum on the large chart, to continue with the clear path on the large chart. You're going to activate a limit order 2 ticks above the highest point, closest to the reversal bar, closest to price. And you're going to put it there because if you remember, this is what your large chart looks like. Your large chart is a freight train of emotion to the upside. There's absolutely nothing for it to bounce off of. So I'm going to enter at the top of the window because I'm not going to trip over a couple pennies. I'm not going to try to reduce my risk and take a lower entry, because the reality is it's more likely to bounce off the top one, but it still has the potential because of the correction point to bounce off the low one. So my limit order goes a tick or two above the highest point of support inside of favorable large triggers. Does that make sense, Pete? Did that answer your question? And then can we throw a hypothetical there? And I'll go back to the favorable large triggers chart. On the hypothetical, right? That line isn't inside of these synthetic triggers. Does that make sense? It's before them. And this becomes a very key part, guys, and I'm making this a little advanced, and I don't mean to, but I'm going to. When this reversal bar prints, I don't have any idea if it's going to be this area or if it's going to be this area, right? Since the reversal bar pretty much dissected the area up there, I'm not taking that entry. That's not a high probability trend trade entry because the reversal bar didn't even print until the wrong side. How could I ever put my limit order above it? Does that make sense, everybody? Pete, this is your lesson, brother. If I have a mid band right here, 3 ticks above those triggers, is it safe to say that my expectation is that the market may correct all the way down here? Right? It might. It might go to the bottom of those triggers. I have to put a protective stop somewhere down here. But what I'm saying is I've got a bumpy spot before the correction point. As long as I'm putting the right stop in place, I might take a trade from that right there. Doesn't matter what I would do, Pete. And I know that sounds silly. It doesn't matter what I would do. Do you want to, the honest answer is I'm so freaking convinced that this is my best entry that I'm putting all my eggs in that basket. This is my entry. This is my high probability trend trade entry, Pete. And if it's a shit trade, pardon my French, if it's a trade where I have to say to myself, I don't have any freaking idea if it's going to go from here to here. I'm so far beyond my correction point, and this is so far, and it's such a wonky look. Why on hell would I double up, right? I'm not in the best look anymore. I'm forfeiting advantages. I'm creating indecision. Why on earth would I double up? I'm just going to put them in right there and put my stop in the right spot. You may have a different plan. Everybody's different, guys. Some of you love to play chicken with freight trains, and some of you wear floaties even though you're 50 years old and in the kiddie pool. It's okay. Everybody's got different tolerances. That's why I like this look, right? Here's my reversal bar, not my entry. I locate my triggers. This is where I expect price to return. Notice how it doesn't bounce off of the trigger. There is one line inside of favorable large triggers, guys. There is one spot. There you go, Morgan. One spot where the market is most likely to continue. One spot for me to put my limit order below. Guys, this is my entry for the highest probability trend trade. All of these areas, they're beyond the trigger lines. These are not part of my area where I expect the market to continue, guys. This is it, one line. I love it when there's one line. I love it even more so when those lines are 2 or 3 lines right on top of each other. And I love it when my triggers are one on top of the other. And what happens, guys, is as soon as you understand where the market is most likely to continue, when you go through 5 days studying momentum, looking at clear paths, pinpointing that entry, going back and practicing this entry, then you know exactly where the market shouldn't go. And Pete, that kind of goes on it too, right? The market shouldn't go 4 or 5 ticks beyond those trigger lines. It shouldn't go outside of that window of opportunity. If it does, it's going to run headfirst into my stop. I'm not going to sit and hope that the market does what it's supposed to do when my advantage is gone. And I see you guys sometimes putting your stops way beyond these areas, way outside of that correction point, and taking $300 and $400 hickeys hoping that the market goes down. Congratulations, ladies and gentlemen, you have Nexgen. You have a methodology that is so freaking precise that you can take smaller losers. You will take losers, but they can be smaller. And the cool thing is, with all those advantages, if the market does head that direction, if it gives you that confirmation bar, that reversal bar, you can reduce your risk a couple ticks above it. And you can take the best entries with all of the advantages, and you can find yourself with maybe 4 or 5 ticks risk. And if it is one of that 20 to 30% that fails, you can take much smaller losses, guys. And it's not uncommon to see you guys taking these sniper entries and then getting knocked out for $40 when it doesn't work, instead of getting knocked out for $240. And I'm going to do that when you guys show me pictures of your trades and I see a stop all the way down here. We're going to have a conversation about where the market shouldn't go. It opens up that lesson. Management's hard. You guys hate to lose. And you hate to lose when you don't trust the methodology. You hate to lose when you don't believe that a pullback to support inside of favorable large triggers is your best option for success. The reversal bar is not your entry. And guys, look at this. Where the reversal bar prints, your large chart was 5 ticks away from Fibonacci resistance. Because you wait for the pullback inside of favorable large triggers, you have the least amount of risk possible, and you have the furthest distance to get back to that profit target. 5 ticks turns into 27 ticks. If you jump in early because you see a fluctuation on a smaller, faster chart, the only thing you've done is increased your risk and decreased your profit potential. If you jump in at the triggers, you increased your risk and you've decreased your profit potential. If you get in late, at least your risk is established. If you don't believe it enough to have a limit order waiting at areas inside of favorable large triggers, wait for a reversal bar. Your risk is in place. Doesn't guarantee a winner, but at least you know exactly what you're risking, right? That's a good way to overcome fear as a brand new user. But guys, the idea is that you learn to recognize this trade. The idea is that you begin to get sold on the idea that when I have odds favorable momentum, when an area even has the potential to break, and I see one of those tails, I want to go look at it. What was that? 290. Oh, that's way back in the distance. Have we had one recently in crude, guys? What did this one look like at 206? Potential to break, almost there. Did you guys see how that happened? Where'd it go? What did I do? Where did that circle go? There it is. Look at the correlation between the two, guys. The tail into momentum, the potential to break, the pullback to support, and it creates a bounce. And then it pulls right back to support again inside of those triggers, and off it goes to the promised land. And what happened inside of this one bar is all these fluctuations. You're watching the fight, but your rules tell you exactly where to put your stop. Your rules tell you where the market is likely to go. Pretty cool, right? This is what we do, guys. It's a weakening of the trend, absolutely. 100%. Let's just see what that tail looked like, just for grins. Right to resistance, right at those triggers. It didn't go beyond the correction point. Look at the split. So Pete, it's gotten a lot easier. It's gotten a lot easier than it was back in the day. And I'm not suggesting anything other than John Novak and I take a very different approach to the way we teach. I always tell John, and gosh, I love my brother. I always tell John that him teaching the software is like Einstein talking to third graders about string theory. He is so brilliant that sometimes it's difficult for him to come down a level. And it doesn't mean that he's a great teacher. He's my teacher. But I didn't understand him for a year. And he would say things like, it's obvious. Look at this. Don't you see this pattern? I was like, no, I don't. I don't see it, John. I have no freaking idea what you're talking about. And he said, it's because you're not following the path, dummy. And he called me dummy because I'm his little brother. He goes, how many pictures have you taken, Mark? And I'm like, none. He goes, how many times have you used a spreadsheet? None. How many times have you posted in my room? None. He goes, well, why the hell do you think you're going to be good at this? And I was like, God, don't use logic on me, John. So what I've done, Pete, is when I started the software, just a little bit about me. We're done with high probability trend trade. Yeah, you did need thick skin back. I'm the huggy feely Novak, without a doubt. So what I did is I failed miserably, Pete, in the beginning. And I'm not afraid to admit that. I spent 30 days on simulator, believed I was brilliant and entitled to win. And I literally gave away 5 grand in 21 trades. I gave away 5 grand in about 2 hours, to be honest with you. And I had absolutely no idea why. And the reality is, it's because I didn't follow the path. And I started teaching a 101 class at 2 p.m. Eastern every day. About, I don't know, probably about 4 months into me beginning to learn the software and really embracing the plan. So I was learning as I was teaching because I was taking everybody through my path. And I was trying to save you guys from all of my mistakes. And then my brother gave me the class, I think 2 years ago, and I took over what used to be the pros room, the AM class. And I've stuck to that very basic path, guys. Recognizing a couple advantages, find your entries, and then grow. Don't look for the money. Look for the advantages. Speak to yourself in terms of advantages. Participate in class all day long. And I really think, and if you ask anybody that's been with us a long time, it's gotten a lot easier because I assume everybody in this room knows absolutely nothing. So when you post a question, I love it. I embrace it and I can't wait to answer it. And it seems to be working out okay, right? Weak triggers at a fib says don't go long, right? All my triggers above support says don't go short. Guys, we're in a holding pattern. You've got to get through these very basic looks so you know when it's a holding pattern and when it's time to take a trade. This drill right here will cement it. Choose to do it or don't choose to do it. Man, it does, doesn't it, Morgan? I'm telling you, the path is true. The path is real. 90% of the people that show up in this room are alphas. You have been amazing at whatever you've done in life. You're the kind of person that when someone handed you a baseball bat, you hit a home run. When somebody said, hey, here's a soccer ball, you kicked a goal, whatever. And what happens is you've probably been at the top of your field in whatever your career was. And most people that come to my classroom, and myself included when I started, weren't accustomed to being a student. They hadn't been in a student role for so long that it's difficult to say to yourself, I'm not in control, I'm not sure, I need to learn some stuff. And it was for me, and it was very humbling. I was really freaking good at what I did. And then I came here, and I felt just special needs. It was so bad, and it was so dejecting, and I almost quit so many times. And then I just finally embraced the process, and it worked. So, guys, you got to know what you're looking for. The things that I take for granted at this point, the things that are obvious to me weren't always obvious. So to get to where you want to be, you got to recognize the pieces in order to find the whole. So Baloo, I'm talking to you, brand new, right? Welcome to the room. This is how you're going to get to where you want to be with the software the absolute fastest. Take 25 pictures of strong triggers and weak triggers and know the difference. Take 25 pictures of a clear path and 25 pictures of a termination condition and know the difference. And watch this. Guys, play along with me, please. Who had a problem trading in termination conditions when they first started looking for trades? I did. I did all day long. Termination conditions, I would trade into them like I was getting paid to do it, guys. And it was just the opposite. And I don't know why, but that's the most broken rule. So go through and really know what it looks like when you shouldn't be trading into an area. And guys, once you get that, life's pretty good. And then take pictures of those 50-50 looks so you don't trick yourself into thinking you have a clear path. But here's the deal. Yeah, me too sometimes, Morgan. Is don't just take pictures. And I told you guys in the beginning, if you want to be successful with the software, it is going to take a little bit of work on your part. Don't just take the pictures. Go through it like we did in the classroom, right? Didn't we take a picture of strong triggers? And we didn't just say, hey, look at strong triggers. We said it's strong triggers because the smalls are above the large, because all the triggers are green, the background is green. This to me means momentum. This is odds favorable momentum. This is a market that's likely to push. This is a market that has the potential to break these areas. This is a market that creates a huge advantage for me through rule number 1. And from this separation to this return is where I'm looking for my high probability trend trades. And if you do that, if you take that picture and you start filling up your 101 section here, guys, There's no way you could go through 25 pictures of strong triggers and not know exactly what it looks like and exactly what the advantage is. And the same is true. Why is it a termination condition? Because price reached the area and the triggers didn't break. And if you open up your large chart, come on, large chart. Uh-oh. If you open up your large chart, you'll see termination to termination to termination to termination, right? You're going to see how rule number 2 keeps you out of consolidation. You're going to see how the easy money happens in between the areas. How weak triggers at a fib was the beginning of the move. How reaching a divergence low with all the triggers above stopped that market and pushed it up. And sometimes even with the potential to break or what seems to be a clear path, without momentum, the market doesn't seem to clear. Guys, you will learn more by not taking trades but taking pictures than you ever will from being just anxiety ridden as a brand new user, hoping the market does something. So I'm going to give you guys this right here. This is your 101 drill. And there's going to be 2 types of people in this room. There's going to be the people that get on this, that start doing it, that take these pictures, and that are kicking ass and taking names faster than the rest of you. And there's those of you that said, well, I don't want to take pictures. I want to make money. And you're going to keep asking me the same questions about strong triggers for the next 6 months while you blow out Apex account after Apex account. I'm also going to give you this, guys. This is a high probability trend trade checklist. This is a checklist that I've never had anybody follow and do worse than 70%. And if you're really doing this to make money, if you're really doing this to be successful, this should be the core of everything that you do, guys. Is the market coming from a good top or bottom? That simply means, did a termination condition reverse the market? And if it did, it creates a huge advantage. You can still take it without, but you're going to manage tightly. Did you have momentum on both charts? Were there no terminations? Were there areas inside of favorable large triggers? Guys, you can take this checklist and write these rules on the chart. Every time you annotate a chart, I want to see you talking about momentum, the path, and your entry. And if you get in the habit of writing these on the chart, guys, you're never going to miss it. You're always going to know exactly what you're looking for, and you're never going to have to ask, hey, Mark, was this a trade? You're going to say, Mark, how kick-ass is this? Look at all these rules met. And if you're just learning the rules, that's a termination that creates a full reversal. That's a strong bottom. This is odds favorable momentum. No matter what chart you're on, guys, whether it is a big chart, little chart, range chart, hour chart, stock chart, I don't care. Separation between the triggers means strength. It's pretty cool. And that will always mean weakness. And now you don't ever have to be confused. No triggers through means that it's not a clear path. Any trades you take into that area are less likely to win. This is just the potential to break, guys. If I take my wife to dinner, to a movie, I walk her to the doorstep, guys, that goodnight kiss is only potential until our lips meet, right? There's a way to get there, but until it happens, I'm not there. And then that's your clear path. And there's your windows of opportunities all the way down to exactly where your limit order goes. Pretty cool, right? Center chart's a 50-50, Pete. It's just a clever way. Look at that. 50% are through, 50% are not. It just has the potential to break. But Pete, I'm going to tell you right now, if you don't have odds favorable momentum, it's less likely to break. Guys, I see somebody sending me private messages. I don't check them during class. I'll check them on the break, but if you're trying to have a conversation with me somehow, I'm probably not going to see it. Post in the chat box here, please. John C., those are small swing one-to-ones. These are the same as the yellow one-to-ones, but they're taken from these tiny little fluctuations. It's my opinion, John C., that they have absolutely no business on an S&P chart or a crude oil chart. They're too small of fluctuations. If they line up with an area inside of favorable large triggers, cool, whatever. But they're so small. The swings are so small that I give them absolutely zero credit. If you're a NASDAQ trader, well, then the game changes a little bit because it's a 34-5 chart, and I will respect a pink 1-to-1 on a NASDAQ large chart the exact same way I'll respect a yellow 1-to-1 on the NASDAQ chart. So when I talk about the areas that can stop the market, guys, and I give you guys this picture every day, where is it at here? There we go. This is for crude oil. This is for S&P. This is for the RTY. This is for gold. This is for anything but NASDAQ. And then once you add NASDAQ into there, John C., add those pink 1-to-1s on your large chart as a potential termination condition. Because the time frame is so high to slow that market down that, man, that's a good question. Appreciate that. Where was I in my big lecture here? So you've got chart reading 101. Choose to use it or don't. You've got a checklist that has never done worse than 70% winners in the history of it. Choose to use it or don't. You have pictures defining exactly what it means to have those rules met that typically win 78% of the time. And now you guys are getting a KISS plan. And the KISS plan is your stepping stone in your learning journey, guys. Your KISS plan is designed to optimize your chances of success with a high probability trend trade. Your KISS plan is what turns you into a chart reader. Your KISS plan is what creates confidence, because anything that wins 70 to 80% of the time is gonna make you confident. And then through simulation, study, class feedback, and continuous practice, there's my favorite AI-generated phrase in Nexgen. You'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, that's a fancy way of saying that when you can read your charts, you're going to find a lot more opportunities. When you understand these very basic concepts, you're going to find entries. Maybe they rely solely on momentum. Maybe they're taking advantage of that clear path. Maybe they're jumping in. Maybe they're counter trend. Maybe they're finding the first move in a reversal. But until you're a chart reader, focus on the best of the best, guys. And your simple plan for consistency says don't fight the large chart. Do not fight the momentum on the large chart. The likelihood of you winning is virtually nothing. Don't trade into the areas on the large chart. Learn to respect termination conditions. They will break just often enough to give you a false sense of security. So keep it very mechanical, guys. Keep it very if-then. If I have a termination that reverses the market, then I will look for strong triggers. It's a flow chart. If I have strong triggers, then I will look for termination conditions. And if there are none, I will look for an area inside of favorable large triggers on a smaller, faster chart. I'm obligated to enter the trade because the rules met. I'm 100%. Either my rules are met, the only thing I will ever be in control of, I will enter the trade, or my rules are not met. Therefore, I will not enter the trade. If you allow it to be that easy, life's pretty simple as a day trader, guys. And then once you get in, you've got to manage it. You got to do something with that great entry. And the cool thing is great entries create manageable trades. Great entries reduce risk. Great entries increase profit potential. In the same way, you'll find a plan through your chart reading to find more opportunities, guys. You will craft a plan tailored to your personal goals based on your experience reading the indicators with management. Your management plan that I'm about to give you that's written out in this KISS plan is the most basic form of management that I could come up with. And it revolves 100% on your ability to understand that the large chart leads the way, that momentum and a clear path are vital to your success. It depends wholly on you waiting for a reversal bar, but not entering on the reversal bar. It depends on you identifying triggers, but not entering when price hits the triggers. It's very dependent on you being able to pick out the areas inside of favorable large triggers and saying to yourself out loud, scaring the dog, this is where the market is most likely to continue. This is where my advantage lies. This is where I want to activate a limit order 2 ticks below and sit on my hands and pray that the small crowd gives it a shove to get to me. And you're going to do all of this while that lonely little reversal bar is still there. And then if you are in that trade with the advantage of momentum, with nothing in the way, having entered where the market is most likely to continue, well, then you know exactly where your stop needs to be. Up here where the market shouldn't go, beyond that window of opportunity, 4 to 5 ticks. And if you study this trade for 30 days, you're not going to give two squats if that small crowd pushes up and hits you, because you know that this is the trade that wins more than it loses. You know this is the trade that's been building confidence. You know that this is your best of the best entry for success. And you're either going to get stopped out, guys, and that's a cost of doing business. That's paying rent on your trading business. Or it's going to give you that reversal bar in the direction of the trade. And if it does, the only thing that you will do is move your stop 2 ticks above that reversal bar. Or if it's a long trade, 2 ticks below. And you're going to say to yourself, I want to move my stops. I want to move my targets. I want to bounce all over the place because I'd hate to lose any money. But you've got to squash that in the beginning. You've got to keep it mechanical. And at this point, there's absolutely nothing for you to do. You're either going to take a small little loss or it's going to hit your first target, guys. And if it hits your first target, it's $100 in the distance. $100 in the distance. That's it. Guys, sometimes that first target's going to get hit on the reversal bar that moves your first stop. I've seen it happen. And if it does, guess what? You're going to go break even. You're going to take all the risk off the trade. You're going to stop worrying. You're going to say, I just got paid. The methodology works. I'm feeling confident. I feel happy. Your wife's going to walk by, high five you. Your boyfriend's going to come by and say, atta girl. The dog's going to nuzzle you. The cat's going to stop peeing on the carpet, guys. And children will sing songs about you because you just got paid. But the trade isn't over. You still have an active contract. Going break even reminds you that the only reason you got in this trade is because of all of the momentum in the clear path. And the only thing left to have happen is either you get stopped out break even or it hits your second target. And guys, that second target is only $200 in the distance. Once again, with all of these advantages, it's a pretty easy target to hit. And it's going to seem like a very short target when you watch the market rail through it. But if you catch $300 a day, guys, and that's the best you can do, that's a $1,500 week, guys, and that's a $6,000 month, and that's a $72,000 year. From the most pragmatic, basic, mechanical approach to trading that I know how to teach. And then once you have the confidence, guys, and this is in the user guides or the client's trade section, is you're going to start to say to yourself, I had odds favorable momentum and nothing in the way. I should probably hold for a bigger move. I took the perfect entry. The large chart is screaming to the downside. I've already been paid on a couple of them. Why not see if that momentum holds to the next one? So Pete, are you asking me, Mark, if the rules aren't met, do I have a rules-based trade? Let me translate. Mark, if my rules aren't met, do I still take an entry? Mark, what if I don't have momentum or a clear path or an entry area? I still take an entry, right? Because the market owes me money. Mark, let's say hypothetically, in an imperfect world, price reached resistance. I know. So Pete, I'm telling you, you're going to be tempted to do that all day long. Man, it's still green and there's a mid band right there and I just want to take that trade. And what you find is that more often than not, your rules are going to keep you out of that trade, right? And it sucks in the beginning for new users. No, there's only 3, Pete. How easy is that? And they're really, really clear. The only way that I'm ever going to look for a trade is if I have momentum, if I have a clear path, and if I have areas inside. And anything beyond that is an opinion. Look how that termination condition won, right? Pretty cool. So now I have odds favorable momentum. How are you supposed to see what, Morgan? The extra rules. I've got a potential window here. We'll see what happens. They are clear. Oh, but man, smart Alec. So guys, I'm going to give you the KISS plan. And then Pete, here's my promise to you, my friend. If you get really good at this, oh guys, that was your 1030 news that created that big spike down. That was your crude oil inventories that pushed that market. What is that? Almost 10 points in a matter of seconds. But what's cool, Pete, is when you get really good at the simple stuff, when you get really good at the basic ideas, when you learn to talk to yourself, and this is the big thing, guys, you should be scaring your pets, saying, I have momentum, I have a clear path, right? And once these two become so obvious to you, Pete, that you're like, I never miss momentum and I'm 100% on this clear path, there's a bajillion entries, man. There are so many ways to pull money out of this market. But if you don't know what kind of trade you're getting into, what I find is a lot of people give it back. So there's two things you have to know before you sit down to trade. This is the final thing that I'm going to give you guys. I gave you all of the checklists, the pictures. I gave you my spreadsheet. There's the KISS plans. Now I'm going to give you the exit conditions. You know what? Let me give you the PowerPoint that I work off of every day. So you have every picture that I've ever shown in the room. And let me give you my spreadsheet one more time as well. And then real quick, and then we're going to take a break. There are two things that you have to know before you sit down to trade, ladies and gentlemen. You have to know where you're going to enter. And you have to know why, right? These are my rules. This is my entry. I am so committed to it that I absolutely refuse to miss a trade when my rules are met, because that's an opinion. And that I absolutely refuse to take a trade when my rules aren't met, because that's an opinion. And we all know what opinions are like, guys. And then once you're in, you have to know what your exit conditions are. And this is what gets new users the most. Because once you're in that trade, everybody is going to look at, and let me show you, this is kind of fun. Everybody is going to look at this number right here. I'm losing, I'm winning, I'm losing. Oh, I'm winning. This is awesome. I love winning trades. Oh shit, I'm losing. Now I'm really losing. Hold it, it's getting better. And you're going to get so hyper-focused that I'm going to see charts with you guys that, let me put my entries and exits on there. And guys, I know this because I've done it. And this is simulator, where it's going to look like this, where you got so scared of the fluctuations that you abandoned your plan, that you stopped reading your indicators, that you weren't looking for reasons. So you have to know what it's going to take to get you in, and then you have to know what it's going to take to get you out. And guys, this is where simulator pays the biggest dividends, because you have absolutely no loss potential. Every time you take a trade, you can't lose real money. Every time you post in the room, you can only get smarter. But this is why I talk about the high probability trend trade. And this is why I say focus on it first. There's only 3 rules and there's only 2 charts, which means you have very little to think about to get into that trade. And once you know why you'll exit a trade, it opens the door to get rid of all these things that screw up a great trade, because you're very mechanical. And that's where on the spreadsheet, this comes in play, because all you're doing is you're practicing following a very basic set of rules that's likely to get you paid more often than it doesn't. That's it. You're practicing following rules. That's exactly what simulator is. So this is why I say you have to know what you're getting into, because if you're getting into a high probability trend trade, guys, you're going to have a list of things that'll take you out over time. Initially, it's very mechanical. But then you're going to start looking for second divergences and divergences from 1-to-1s and large chart areas and 3 divergences in the same range. And your management plan is going to grow as you grow. But here's the deal. If you take a 50-50 trade, a medium probability trade, it has to be managed differently. And if you don't know your management plan like the back of your hand for a high probability trend trade, well, then you may try to manage it like a 50-50. You may try to manage a momentum trade the same way that you manage a high probability trend trade. And guys, There's a reason that we start with a foundation. There's a reason that I start very, very basic so that you can grow from it, because the less you have to think about as a brand new user, the easier it is to execute. And then once you're a chart reader, guys, all those things that can take you out of a trade become very recognizable, and they become very recognizable at a moment's notice. So that's my first hour. When we come back into the second hour, Jonathan, get your listening ears on, because I'm going to go to your chart to show exactly how we're going to do it, because I know that you have to leave at 11:15. And I'm not going to click on the one that just says trade. I'm going to go to the one that's annotated. Guys, remember, you have to tell me what you see. You knew when you made it was likely to fail, but you wanted to confirm why. You had momentum on the small triggers not turned down yet. Large triggers not through the fib, so not a clear path. Trigs on the small chart had too much spacing. No. So Jonathan, here's your lesson, brother. This is the same one that we've had every day. So today I really want you to pay attention to this one. You jumped into the trade. You just jumped in. You didn't wait for a pullback to an area inside of favorable large triggers. So because you just jumped in, and you didn't even jump in with a clear path, you jumped in directly into a fib. I mean directly into a fib. Do you see it? You knew it wasn't a clear path. And then Jonathan, here's your lesson. And I really want you to take this one to heart. And I'll keep saying it as many times as I need to say it. And we did it this morning too. There's your small triggers. As long as price is on this side, life is good, Jonathan. The second you jump in on this side, you can't jump into a trade. You just can't. Your momentum's gone. Does that make sense? Once you get to the wrong side of these triggers, guys, this is our entry rule lesson. We're waiting for a pullback to an area inside of favorable large triggers. So Jonathan, as long as you keep doing this, this is probably going to be your result, right? So we're identifying patterns. And then the other side of that, if you jump in on the right side, you can hold that mofo until it gets to the wrong side. Thank you, Andy. Great timing. But Jonathan, this is your lesson, brother. Your large chart reads have become outstanding. But the one thing that you're not doing, and Jonathan, I'm at the point where I really like you from all the participation, and I feel like we have a good enough rapport. As long as you don't have entry rules, you're going to jack up a lot of trades. As long as you don't have entry rules, and that's the one thing that you never tell me, is why you enter the market. So until you develop an entry rule, you're going to keep losing these trades. But the second, Jonathan, you come up with an entry rule, I guarantee you, you're going to be in a lot lower with a clear path, making money, instead of trying to jump in at the end of a move because you said, holy shit, I didn't get paid all the way up. Does that make sense? You are so close, Jonathan. You are so close, but you need entry rules. So focus on the rules. Focus on writing down on the chart what it is that's getting you into the market. Because you've got it. You know it. We've taken so many pictures of you taking beautiful trades, but you haven't yet talked about why. You haven't yet talked about why you took those beautiful trades. You haven't yet talked about the conditions so that they become repeatable. And guys, this is what the classroom is. This is me being that annoying voice in your head. Was that the one? I'm that annoying voice in your head that says, know why you did it. Write down why you did it. Talk about why you did it. Because as soon as you can repeat it, guys, as soon as this look gets you into this entry, you know exactly what kind of trade you're in and you know exactly where you have to take it off. I got you, Jonathan. We're going to beat this one together. We are going to beat this one together, but I'm going to annoy the hell out of you telling you to write entry rules. And if you need help, Let's do it. Let's figure it out. Guys, I'm going to run for about 5 minutes. I'm going to take a break, and when I come back, we can watch the live market, but I'm going to start clicking on every one of the charts that you guys have posted, and we're going to talk about the advantages. We're going to talk about momentum, a clear path, and entry, no matter what kind of trade you took. You're going to see people taking high probability trend trades. You're going to see people taking medium probability trend trades. You're going to see people taking these weird jump-in trades. I don't care. Doesn't matter what kind of trades you take, guys, but tell me why you did it. Tell me what your entry rules were, because that's the part we have to repeat. We have to know exactly why you got in so that you can define the trade and know exactly when it's time to get out. I'll see you guys in 5 minutes. Go stretch your legs. All right, guys, here we go. We're going to get into the second hour real quick. Give me 1 second. I got to do a little thing on Discord because it's not allowing me to pick up your pictures. So don't panic. You can probably still hear me. You just can't see me. I'm coming back in right now. Nobody worry. Let me share my screen real quick. And guys, we're going to go up. I'm going to scroll up to the very top of the room. And we're going, all I'm going to do is I'm going to look at what you guys are doing. All I'm going to do is look at what you're doing. We're going to talk about advantages. We're going to go through it and see if there's anything we can do to do it better. I know there's not a lot of pictures in here, so I want you guys to be thinking about the questions that you have, because when it's FOMC day and the market isn't giving you what you want, it's a great opportunity for you guys to ask questions and move this classroom a little bit. So this is from yesterday. And Andy said that with this look, since there were no areas inside of triggers, he would wait for a confirmation bar. He would wait for a reversal bar in the direction of the trade. And even with that confirmation, there was still a lot of money to be made before the first trouble. So good stuff, man. I like it. And then here somebody had odds favorable, momentum, and a clear path from a strong top and took an entry at a mid-band inside of triggers and got out right at Fibonacci support. Guys, this is one of those ones where I'm just saying, I would take that picture and I would drop it into that right there. And I would say something clever like perfect short. This is the picture to build your plan on. And guys, just that's mine. That's my trade from this morning. This is the one that I waited 2 hours. 2 hours for. And I almost hit my goal with that one. And then coming off of a termination condition with all of that momentum, Jonathan, this is a good look for you. I had split triggers, right? I had areas on both, but because I'm a chart reader, I recognized the termination. I recognized that it reversed the market. I identified those crazy strong triggers, and I waited to get to the left side of those triggers because then I knew I at least had a shot. And I stayed in that trade until price closed on the wrong side of the triggers. And that was where I got paid, and that was goals met. And I started setting up for class, guys. And that same picture opened a beautiful lesson for what we call the gap theory. And the gap theory states that if price accelerates away from these large triggers, does everybody remember when we said that price tends to return back to trigger lines? Guys, if price accelerates away from these large triggers and it hits a mid-band or fibs or anything, it's likely to close that gap. That's called the gap theory. And this says no more long trades until you're in a position in your career where you know your rules well enough to bend them a little bit. So a lot of good lessons on that one. Most of them revolve around, hey, if you have rules, follow them. That's it. If you have rules, follow your rules, because your rules have been proven to create a statistical advantage. And then Steve Diego, I'm going to open, it's not letting me open it. Son of a gun. All right, guys, I got to do that Discord thing again. Hold on. I'm so sorry that I have to do this, but for whatever reason, guys, the screencast links work great, but when you copy paste in the room, they don't always open. And it seems that a reset is the only way I can make that happen. So let me get back to the room real quick. Coming up again, guys. Sorry. Apologies. There we go. And I'm back. So Steve, I like this one. Second higher divergence fib, strong bottom, perfect read. Small triggers are strong up, right? Waiting for that roll. Odds favorable momentum, perfect read. And you're looking for entries. And you're looking for entries. And I love that you put that. I'm looking for entries. And Steve, your mindset is 100% right. Termination, full reversal, odds favorable. Let's find a way to get into that market. So there's two things that are happening here. The first one is that your large chart read is freaking amazing. That your large chart read is so full of advantages, I'd be looking for an entry too. Without question. And I love that you put potential to break, right? Because there's never should break. It's always potential to break. And what stinks and what's a reality of trading and a reality of the business that we have is that sometimes it's just not my money. Sometimes I have every advantage and they don't give me an entry. Sometimes I have every advantage and I don't have that rules-based entry. And that's okay, right? In the beginning, there's fewer opportunities because you've got this blanket rule kind of keeping you safe. And you asked in the room, if I entered on these reversal bars, where does my stop go, right? If I entered on these reversal bars, where am I going to put my stop? So, of course, I answered, I don't have rules for that. I don't. These would have to be your rules. But here's the deal. If I enter on what I consider to be a confirmation bar, hypothetically, my risk is going a couple ticks below the bar. But I'm incorporating that same thing. If I'm jumping in because of momentum, I'm exiting without momentum, right? So maybe I'm in here and I'm out here, and that's a break-even trade. And then I'm in with confirmation and I'm out, and that's pretty much a break-even trade. And then I'm in with confirmation, and that's the one where I make money. So there's probably 3 trades that I took, and I probably only got paid on one of them because I'm just jumping into the market. And if I'm just jumping into the market, I'm relying on momentum. And if I'm relying on momentum, well, then I have to say something intelligent like, if momentum is the only reason I'm getting into this trade, then why on earth would I stay in it without a loss of momentum? And by that same reasoning, my smalls are below my large all the way through. So that would kind of take this one out of the equation at all. That's not even, I don't even have momentum on my small chart, which means that this is your first shot right here, and it's break even, and there's your second shot and it goes. But I think using those reversal bars and protecting yourself behind them is a great thing. But I also think that this is very much a prime example of how every move in the market doesn't get to be my move, because I can't find a statistical advantage, because I can't find a pattern that's been proven to win more than it loses. And I have to be okay, and I have to accept the fact that sometimes I'm going to sit on my butt for 30 minutes, 4 hours, because this is a business, right? This is a business. This is my trading business, and my goal is profits every day. So I'm okay not catching every move, because every move doesn't give me a great opportunity to make money. But if I'm patient and determination creates odds favorable momentum, this is the best look for a momentum trade ever, guys. I want you to see this. Small triggers break the one-to-ones and snap right back to the one-to-ones, guys. You let the triggers break the small chart, you have odds favorable, and he rides that all the way up to trouble. And GWC does this better than anybody lately. Well, GWC and Ron are kind of in the same page. So Jonathan, you need to be studying his entries, because that's what you're trying to do, but it's not working out. You should be stealing pictures from people that are doing what you want to do and see how they're doing it. And GWC does this one great, but he's in on the left side of the triggers and he's out before it ever gets to the right side of the triggers, guys. And that's a huge lesson for you guys that want to be jumping into trades. For you folks that say, oh, there's momentum, I'm just going to get in. Make sure that you actually have momentum. And there it is again. Left side of the triggers, odds favorable momentum, coming from a termination. And he rides it right up to trouble. Gosh, UWC, absolutely beautiful. It's not a high probability trend trade. And then Jonathan, just great timing. Do you see the difference between his and yours? His is on the winning side. Yours is jumping in on the dag-nabbit side. Once again, the dag-nabbit side. And you got punished for not doing what we talked about yesterday and holding on to one for break even just in case it runs. Just in case. So you made the choice to trade into the termination condition. Right, Morgan? You said because of the momentum, because there's no divergence. Absolutely there is, Steve. We got it this time. I'll post up the link in the room at the end of the day, or you can go to the Nexgen page to the live. Let me give you a link to it. And all my classes for like the last year and a half are on that page. Oh, and then Morgan, I closed out your picture. Sorry, here we go. Go back to Morgan. So Morgan, there's one operative word here. One operative word, smash, right? Less likely to break if it doesn't smash through. There's no divergence and you take a shot and your entry is beautiful and your stop placement was right, and because of that termination, they almost got you. Are you in here, Morgan? You know what? Let me read all your stuff real quick. This is a 50-50, not a high probability, no trigs. That's a good bottom. Absolutely. No divergence. Waited for the pullback. Missed your stop. Awesome. We're good. OGTP. Profit target? The original profit target? Or the Toffet Proget, I believe is what you had there. Oh, take profit. Okay. Was at the fib, but it dropped much further than I thought it would, so I damaged my confidence in the trade. So as soon as it started having trouble, the position was sold off. Right after selling it off, I remembered what we talked about yesterday and selling off my position and going break even on the last one. Cool. So from 28.75, you had to make it to 30.75. And that's $100 profit. Very, very mechanical, right? Did it end up going down from here? It went up? Okay. Well, it still would have got you break even. It still would have been a $100 trade though, right? That's it. Because if I'm in here directly into a fib, and I get my $100 and I go break even and it stops me out, I'm totally cool with that. Because look at how much everything has changed, Morgan. And this is where I don't want you to let what happened after affect making good decisions in the moment. Off of a termination condition, your large triggers rolled over. For a lot of people, this sets up looking for shorts. You have odds favorable momentum to the downside. For a lot of people, that's a pretty good one, yeah. So to get paid and stay out of this fight that's happening at a fib, because that fight went from 33.50 all the way to 26, 7 points off of that fib. It also gave you the third divergence right in the same price range, right at a fib. That's a huge termination condition. The fact that it went up from there, don't let it affect you, dude. I think you did this great. I think you got in at the right spot. I think you identified your trouble beautifully, and when it didn't break through, you said, let me get paid and get the hell out of here. I love everything about this trade, and I think the fact that you noticed there was no divergence while you took it, solid. I think you did a great job. Sorry, I can't beat you up on that one at all. I think that you made good decisions based on what your indicators were saying. And it looks like you know why you did everything. And that's the most important thing, is that you understand why you did what you did. So good stuff. Mark, is this an example of a PSO? Jen, you better believe it is. So let's draw it up because we're going to run out of pictures quick. What's a pivot stop out? There's two parts to it. Oh, you know what? I've got a little blog thing written for it. So let's go through it from the blog thing. I'm going to give you guys stuff today. I'm working on these little snippets, guys, that really help, I think, take a singular lesson and drop it into just one little focus lesson so that you're not distracted by everything else. So the pivot versus the pivot stop out, guys. When price goes up and down, when price goes down and up, it's a pivot. It's just a spot where the market changes direction. And if the momentum of the market doesn't follow price, if there's a disagreement between price and momentum, this is called divergence, guys. And it simply means a loss of momentum. That's all it is. There's a pivot, there's a loss of momentum. There's a pivot, there's a loss of momentum. And if I look at Jen's picture, that's what she has going on right here. Here's a pivot. Here's a loss of momentum. She's not giving it any power. She's just saying, hey, look at that. Whatever. No big deal. And then we get into termination conditions, guys. And when price reaches that divergence low and the triggers remain above, now it's a termination condition. And then to turn it into a pivot stop out, price goes above a tick, 4 ticks, a point, whatever. If price trades back below that divergence, that termination condition, guys, it becomes a pivot stop out. And pivot stop outs are powerful, especially when they coincide with fibs. And pivot stop outs are going to happen all over the place in their termination conditions. So what Jen did is a brilliant observation. This is just a pivot. It's a bad bottom. There's nothing going on. Sure enough, the midband holds and they come and retest it. And when they trade below 2 ticks, you don't think these are important? Back above, it says no more short trades into the area. Great picture. Jen, you know what? I'm going to steal your picture and I'm going to go to the client trades and I'm going to go to termination conditions. And I'm going to call this one PSO because I think that's about as textbook as you can get. Thanks for that picture. The spreadsheet is one picture better now. And I missed this one. Sorry, Jen. There's your pivot. There's your termination. There's your odds favorable momentum. There's your midband. There's your profit. Nice trade, Jen. Taking very basic concepts and turning them into trades. I love it. Great annotation as well. Appreciate that. And then GWC again says, look everybody, it's not the best momentum, but we're clearing the areas. And my small chart says the price just isn't going to go down until it gets to the wrong side of it. So why not make some money? GWC, rock star, man. You have found your thing and you do it well. Now guys, I want to point something out real quick. And I want all of you to listen to this part very, very carefully. Every trade that GWC has posted in this room has been a winner. Every trade that GWC has posted in this room embraced momentum. Every trade that GWC has posted in this room today looks exactly the same. Guys, the people that are reaching their goals are the people that know exactly why they're entering the market and know exactly what it takes to get them out of the market. And you'll see it day in and day out. The people that are finding success are the people that are doing the same thing over and over. So you took the momentum style trade, Morgan, and you exited with the loss of momentum. Management was super aggressive. You didn't think it was going, so your stop loss was the low of the previous bar. Just looking at the last few ticks before the fib. You had $100 worth of room from your entry. Steve, you can't. Maybe you could send them a check, or they're all posted in the room. Steal them. Scroll up in the chat box, find them, take them. It's not going to do you any good, my friend. Learn your trades. I always tell people that. Learn your trades. Or if you want to steal his charts from the room, that's cool. It's public domain, but you're going to have to annotate what you see as well, because it doesn't matter what GWC sees. It matters what Steve Diego sees. Morgan, that is just so tight. You did well with it, but that's so tight. I like to have a little room to run, but nicely done. But Steve Diego, scroll up. You can take every picture ever presented in the room if you want, if you see something that speaks to you. Go right ahead. But guys, I want you to resist the urge of reaching out to the other students and saying, hey, teach me what you're doing. Oh, you just posted it twice. It's so tight, dude. And you were, I don't necessarily say that, that it was too tight. You had momentum, you had room to the fib, you had a rules-based entry. You knew that it was tight. Right? You knew that it was tight. You said that. It wasn't kind of dumb at all. And let me talk about why, Morgan. Let me talk about why. You did have odds favorable momentum. You did have room to the target. The smalls did break. You did grab the perfect entry. And you knew that trouble wasn't far away. And you weren't willing to lose. I think, Morgan, once again, you're selling yourself short. You're equating trades that don't work with mistakes. I'm talking about trades that you have that look absolutely beautifully managed, that are logically managed, that had room when they got in, that had reasons for entry, and then you're beginning to recognize when there's reasons to be aggressive on your management. So I'm not going to give you kind of dumb haha on this one. I'm going to say that you're actually making good decisions based on what your indicators are telling you. Your indicator said that they may stop there. You recognized it. It came to the wrong side of the small triggers. You know that's a loss of momentum on what is a momentum trade. So you might need to celebrate a little more than you beat yourself up. That was kind of nice, dude. I feel like you did well with that. And then Andy, let's see what you did. Nothing worse than thinking you did something wrong and I come in and tell you that you did it right, right? So there you go, Morgan, the exact same trade, right? 100%, exact same look. Odds favorable, breakthrough, snap back, money at the target, out on the close. Absolutely beautiful, Andy. Andy, I've watched you take more successful trades in the last week or so. It has been awesome watching you come into your own. We already looked at that one. All right, Cheetah. Cheetah, you wrote odds favorable momentum on the large chart and entry at the mid band and 1-to-1. Put the call out on the chart, but somehow it disappeared. No worries. I appreciate you dropping it in here. So smalls are rolling, strong triggers. The only challenge with this one, Cheetah, and I'm going to talk about the good and the bad. Man, there's a lot of there's no fibs going on, which is always a concern for me. I don't know what the NASDAQ looked like at 7:30 this morning, but I want to say that there should be a lot more fibs on your chart than just this one. I had a lot more on mine this morning. That's at 8:30, 1943. I don't know if we can line them up. That's below what you have going on here. So maybe that's post-news. Maybe you're at a different time frame. And you traded beyond those areas. So Make sure that your tick data's on. Make sure it's going. It didn't stop loading. We did hit a point where we were beyond all the fibs. Andy posted it in the room too. If there were a termination condition right here, if it was coming from a fib, this becomes higher probability. So what you have here is you have the loss of momentum and the small triggers flying up. Let me see how I can work this lesson in. Cheetah, have you been listening where I said, as long as the bars are left of these triggers, it's pretty much going to keep going up, right? It's true on the large chart too. And then we get these little fluctuations on the small chart, and your fluctuation was right back to support inside of triggers. And you had these split triggers, and this is kind of hard to read. Let me pull them up. You had these split triggers. You had these two correction points. Only one of them had areas, so you traded from the areas inside of triggers. I love it. And this isn't a high probability trade by any means, because we're not coming from a good bottom. We don't really have odds favorable yet, but what we do have is beautiful momentum, that immediate momentum on the small chart, so much so that it's in the small trigger phase, the same thing that pays dividends over here. You're able to capitalize. You get in, your stop placement was in the right spot, and this is a great look to carry you all the way up to trouble. So I like it, Cheetah. I think you did a good job on that one. It's not a high probability trend trade because your trigger lines don't even agree with one another, but you had one spot where that thing was likely to take a bounce, and you took your shot at it because the large chart said giddy up. So you entered above. So over here or over here? I'm just going off of the box. Over here? Even better. You said, I'm not sure where it's going to go. Let me start back up. Beautiful, Cheetah. Nice job. I like that even better. You see how that yellow box was a little misleading? Nicely done, man. Clear down path. Jump in. And as long as it's going, you're staying in. I can't fault you for that. You had room to the target. And you carried it all the way down. Nicely done, Andy. Andy, you and I are getting to the point to where I'm just going to say nice job and we're going to high five. Ooh, what charts am I looking at here? It was cranking. Is this your large chart? 3 divergences in the same price range? Creates momentum. And with odds favorable momentum after a termination condition, you get a little snapback right to the large triggers, right at the area, and you hop in on the correct side of the small triggers, and the momentum doesn't give you a close below until all the way up here. Cheetah, I think you found your thing, man. Your patience is amazing. You're skipping indecision and getting to the right side of things. And with this look on the large chart from a termination, you got plenty of room to make it happen. Nicely done, man. All right, Joel Beal. Skip this trade because of 3 divergence on the entry chart, but notice 3 divergences are each a little lower. Thoughts? Let's look at the whole picture. Joel, are you in here? Yeah, you are. Cool. And Joel, I know you're a little more advanced. You're making me work on the read though. Here we go. Let's blow it up a little bit. All right, large chart. Bad bottom, pulls right back to the fib, continues down, right? My first thought is I don't have momentum. Ooh. And that's okay, right? You're anticipating more down based off of the fib holding and all your triggers red. Totally cool with that. 1 divergence, 2 divergence, 3 divergences in the same price range with weak triggers. My thoughts, Joel, are that you followed your rules. And that last circle is also at a pivot stop out at an outer band with the smalls on the wrong side of the large and stranded sellers. So if I'm being 100% honest, Joel, you did a great job following your rules. And here's what you have to ask yourself on trades like these. Because when you look at the chart, it's not pretty, right? You don't have momentum. You don't have a clear path via the 3 divergences. And even your range chart's pretty ugly. Can we agree? And this is where people will change their plan based on one reaction of the market. Joel, it went down anyway, man. You didn't have momentum and it went down anyway. You didn't have a clear path. It went down anyway. So let's go through the way I teach it every day. How's that? 3 divergences may terminate the trend. 3 divergences with weak triggers is more likely to terminate the trend. Joel, the only thing that you didn't get was the higher pivot. That's it. The only thing that you didn't get was the higher pivot. You were 2/3. You were 2/3 of small chart term options. You had 2 out of 3 of the small chart term options. Just because that one's lower won't change it for me. It just went down. That's it. And it stinks because it did that and you're like, oh, I knew that I should have. But I don't know that you did. I think that your reaction is more based on what happened after rather than what was happening while, potentially. It's a good picture, man. Andy, momentum trade, you get paid. Held that one a little long, wouldn't you say? Or that one just turned into another momentum trade. You went break even on the second to see if it would run, even though it was a momentum trade and had a loss of momentum, Andy. Do you see how this is the first time? This is the first time, my friend, that I see you breaking your rule. This is the first time that I see you breaking that rule. Hey, have a safe trip home, Morgan. That's all right. Your home is closer to El Paso than my home is in Texas, I think. Kind of funny how that works. Texas is big. Andy, love your entry. 100% awesome. Love getting paid on the first one. 100% awesome. Andy, this is the first time I've seen you break your rules and not get out with that loss of momentum. Okay. That's all I'm saying. Do with it what you will. You also have the gap theory pretty big here. I love your entry, dude. That's all the momentum from a great bottom. Just not a home run. Nicely done. Guys, I'm going to take 3 minutes. When I come back, that's all the pictures. So it's going to be on you guys to run the rest of the room. To tell me what's going on in your world, what you want to talk about. Give me 3 to 4 minutes. I'll be back, guys. Mic silence. All right, y'all. Here's a pretty good example of the difference between opinions and rules. And I want you guys just to look at this. Large chart said down. And the large chart said the smalls are still trying to stay outside. And the large chart was at a fib. And there's so many people that looked right and said, but Mark, there's a fib right inside of green triggers. I'm going to go long, right? You've got to let the large chart lead the way, guys. Because when the large chart says down, when the momentum is there, when everything is going down, don't let a small chart talk you into something. Don't let the small chart talk you into a trade that you don't need to be in, that's void of advantages. And I see it a lot, but the small chart said go, right? Well, this is a kind of a good example too. The large chart said that we might have put a bottom in. The large chart said weak triggers, at a termination. Even the small triggers rolled. But it traded directly into fibs, and all the triggers remained below. Some of you thought, man, I can't wait to go long, my chart is green. And you abandon all of your rules, and sure enough, it didn't work out. There's those 3 divergences again, right? 3 divergences, 4 divergences. That's the one that made it go up. That's the one that takes you past that fib. So the rules are a big part of, it's just a safety measure, if you will. And since nobody's posting pictures and the market doesn't seem to be giving us anything, you guys just have to hear me flap my gums a little bit. And that's okay, I don't mind. So the key to everything that I teach, guys, the way that I teach it, how I teach it, there's a method to my madness, is you have to have a foundation. You have to have some basics in place so that you can see the big picture. So for you new users, Rob, for all of you new users, for you guys that are brand new with me, for you guys that feel like I'm shackling you to one trade, guys, I give you very conservative, I blanket rule, very conservative. I know that I do this. I do this for a reason. Everything is about recognition of advantages, right? You've got to be a chart reader. I give you a very solid plan that optimizes your chances of success as you learn to read the indicators. And so for all of you new users, every termination on your chart is bad, right? Every line where the triggers haven't broken is a death sentence, is the way I make you feel in the beginning. The same thing about momentum. If there's not momentum, why would you ever consider taking a trade? What are you doing? And the same thing is true with areas. If they're not inside of favorable large triggers, what the hell's going on? And guys, I don't do this because they are always bad. They're not always bad. But you don't have the reps yet if you're brand new to understand when exceptions can be made. So it's safer, if you can use that word in futures trading, it's better. It's more probable that you're going to win. Awesome, Ron. Have a good one. I don't even open my charts FOMC in the afternoon. I've got a friend coming over and we're going to tattoo her forearm for a couple hours instead of try to trade it. So just go hang at the beach. So in the beginning, guys, all these rules are bad. All these rules are horrible. All these rules are designed to keep you safe, to increase your confidence. And then the more time you spend with it, well, the more you're going to see. And this is going to open doors. And this is why, it might not be your money now, but it may be one day, right? These momentum trades that you're seeing people take, these jump-in trades, that might not be yours yet because you don't understand momentum yet. But with some repetition, you're going to see it. You're going to know when it's okay. But you're going to get these challenges where new users see more experienced users taking trades that don't fit the rules, and it's going to confuse you. Or it's going to say, you're going to go, I want to do what Andy's doing, right? I've been here for 3 days, and I want to do what Andy's doing. Andy's been here for 3 months, studying every day, posting charts every day, practicing every day. And it's a little egocentric to think that you're going to walk in and match strides with somebody that's put the work in. So keep it safe in the beginning. And then once you get a little time watching the software, once you start to recognize these advantages, you might get in with a little less than perfect momentum. And you might trade into a termination condition because of conditions on another chart. And you'll become a little less rigid and your trading plan will change. It will literally evolve as you evolve. But you've got to learn the process that yields results. And then the results seem to follow. And that's where the KISS plan comes in, guys. If you keep it very basic in the beginning, if you're okay not doing what everybody's doing, you can find an extraordinary level of success. I watch it all the time. But the further that you deviate from easy, the further you stray from high probability, the longer it's going to take you to get comfortable catching the best patterns. So keep questioning everything, guys. If you see a trade that isn't a high probability trend trade, ask a million questions. I'll do my best to answer it. I want you to learn, but give yourself a little bit of grace. Allow yourself to be new. Allow yourself to not know everything yet. And guys, look at this market dancing. If you don't think decisions are made at fibs, you don't see it on the large chart so much. Look what's happening on the small chart. How many times can you go short or long without a clear path? How much money could you possibly give away right here? I could give away a lot. I have given away a lot. But it's not an accident, guys. It's not a mistake that they went below and above and below and above. Steve Diego, will you do me a favor and show me a picture of the ES at 1048? And we'll walk through the rules on it. Is that fair? Cool. I hate to appear lazy, but it's so much easier for you staring at that chart to take a picture, drop it in, and say, hey, can we talk about this? Instead of me having to change charts, scroll back, and then try to guess what it is that you're thinking is a trade setup. At 1048, I don't have any rules met. How easy was that? No longs, weak triggers. When divergence prints with weak triggers, there's my range right there. Mid bands, fibs, anything down here is where I expect a bounce. When it's not from a good top, this is exactly where my first target is. I'm a couple ticks above a mid band. So for all intents and purposes, when I get in this mid-band range, when it's coming down and these large triggers are lagging behind and a full bar behind, this is that gap theory that I talked about earlier. This says, hey, price is likely to close the gap back to those triggers, which means that if you tried to jump in right here on these split triggers, you got absolutely run over and annihilated as the gap theory did its thing. Once it closed the gap to the second correction point, if you were convinced the market was going to continue down, you would have wanted some sort of confirmation. If you took that confirmation bar, I don't know, what happened next? Looks like you could have done okay. And it made it to the fib. So, not a high probability trend trade. Understanding the gap theory keeps you patient. And then Paul, waiting for confirmation when it's this freaking ugly, creates a huge, huge advantage. And I think that's one of the things. Steve, thanks for pointing this out. Sorry, I jumped ahead. I'm impatient. I know that I am. I think it's going to go, but the market didn't say it was going to go, right? It could go from here, but nothing says that it's going to go from there. There's the potential that it'll go when it hits the triggers, but everything is still aimed up. And then once I get a confirmation bar, I want you to see how everything plays out. Weak triggers pushes it all the way down to here. Large triggers lagging behind lets me know where price is likely to correct to. There it is, same lesson from entries. If you say to yourself, smalls below the large, larger down, tons of momentum, I'm willing to take a shot at this one, Steve. Exactly, there's your confirmation bar. Force the market to prove to you that it's going in the direction you want it to go when you really don't have the best look. I'm a huge fan of confirmation, guys. And I'm willing to pay the price for confirmation. I'm willing to pay the extra 7 or 8 ticks. Because from the confirmation bar, let's do the chart read. Weak triggers took me exactly where I thought it would. Gap theory took me exactly where I thought it would. So this is just patterns. You've got to learn these patterns. And then, that's way too big. I'm just going through my thought process. Well, that didn't work. When gap filled, what did my large chart say? And this is what I'll ask for myself when I'm trying to make a decision. And there's a lot of things that kind of came to be. The first one is that my small and my large remain down wide, angled in the direction of the trend with odds favorable momentum. So I really do have odds favorable momentum. Because I studied my entry points, because I studied pullback to triggers, I've heard Mark say 500 times that when they're split, I don't know where it's going to correct, right? Is it going to go low or high? I have absolutely no idea. So when it gets back to the upper correction point, what's the whole read? The whole read is odds favorable momentum. It's room back to the fib. Every chart says down. And confirmation bar says, here we go, at least my risk is in place. And I'm going to tell you right now, guys, it's going to take you a little bit to be able to do all of these computations in the time frame. But you'll get so good. You'll get so good at recognizing patterns, Steve, that as this market is hauling butt down towards the mid-band, you might look for an entry. And when it gets there, your brain is already looking to see where these large triggers are. And it's already saying, man, there's two things that can happen when it gets back to these large triggers. It's either going to continue up because it didn't stop at a termination condition and they might want to go to the next fib, or this is the most likely spot for it to go down. The reality is I don't know. And this is what you have to do, is you have to say, I have absolutely no freaking idea. Absolutely no idea what's going to happen right here. So if I'm going to take a short, I better get a confirmation bar. And if this short fails, I'm probably going to start looking for a long. Awesome. Thanks for asking. I do appreciate very much you guys posting a picture in the room to talk about it, because I think it makes it easier just for me, and maybe I'm being a little lazy there, and I apologize for that. But let's go into this, guys. When I don't have a good top, when I'm not coming from a termination condition, 50-50s right here are less likely to work. That's a pattern. And one of the patterns that you'll see is a lot of the time, because they know where these fibs are, when it fails from the middle of nowhere and gets stuck at support, it's not uncommon for them to finish the move to the next area. I don't arbitrarily go long, but I'm not taking a 50-50 with multiple divergences, right? So we used to do this in class. My brother used to do this, and it would drive me nuts, is I would go short somewhere right here, and right about then my brother would say, all right, we had a bad top and a 50-50 failed and the small triggers are up and the larger above support, they're probably looking 53 first, and then if they break 53, let's talk about 64. And I just took 3 short trades that I got my ass whipped on because I didn't understand the patterns of the market the way my brother did. So check it out. Let's see if there's any truth in it. Right off the fib comes back, that's good. Small triggers break through, so it's not a good top. Right off the mid band, it continues up. Bad top, middle of nowhere, bounces off support, finishes the move to the fib. Man, everything says up. They don't quite make the fib. It comes all the way back to the mid band, and there it goes, and they finish the move. Are you guys seeing the pattern? Everything is up. They stall out in the middle of the nowhere. They come to the mid band. They make it straight to the termination. They go back to the mid band. There's that fight. You guys knew about it through rule number 2. And then they continue that upward movement even more. Pretty outstanding the way that works. It really is, because it happens a lot, guys. It happens a lot. These are just patterns that you're going to start to recognize over and over. You're going to see them happening almost every day. Do you see how the small triggers have changed direction, how the large triggers are still above support? This is where we have the ability as Nexgen users, as rule followers, to say no matter what my opinion is, I'm not going short into this area because this area is a termination condition. But you also have to say, but it's really too soon for a long, right? My small triggers are kind of going up, but my large triggers are still down. I don't really have momentum on my other chart, but I'm gonna pump the brakes. Shorts are off the table. So I start going through this if-then. If these small triggers come up a little further, if I get back above these triggers, right, I might look for an entry. I might look for something to do there. Because now I'm coming directly off of support. And if it reverses the market, it's going to be a strong bottom. And if it's a strong bottom, it's the precursor for the highest probability trend trades that I can take. And in my own world, guys, I would have already been long at this pivot stop out at support. But that's just me. I have a plan that says I'm willing to take a shot off of support, and it might lose. I don't have any rules that I teach for this trade. But the look of 3 divergences, support every trigger above, a reversal bar for confirmation, I'm willing to take a shot. Does that make sense, everybody? I'm in the momentum phase here. Andy, everything says up, perfect entry, money, money, right at trouble. Absolutely beautiful, my friend. Those big yellow 1-to-1s, Andy, oh, that's a great exit. You gave it a shot, though. I like it. So Steve Diego, this isn't anything that I teach, right? And if I get a divergence here, I'm out of the trade. It's not a high probability scenario. It's not even a medium probability scenario. I'm fighting the large triggers. I'm putting all my eggs in the basket because the small triggers are up, because I'm coming from a termination, because my large triggers rolled. It still doesn't have to win. I'm still breaking the rules of momentum. I'm still breaking the rules of entry areas, right? It's not a high probability trade. This is me being willing to bet a couple bucks on a pattern that I've seen a few times. Yeah, a little head and shoulders there too, huh? You know, I didn't even know what that was, Steve, until I started teaching. I didn't know what a head and shoulders were. People come in, they're like, yeah, Mark, I'm trading this wedge. I don't know what a wedge is. Hell, I have no idea what a wedge is. Thought it was a salad. So this is one of those times where as you grow with the software, you might make different choices. This one's probably going to lose though. Sure looks like it's going to lose. I don't know. We're just letting it play out because it's sim. Because right now I'm building a trading plan. I'm saying, can I break all my rules and still win? And if it wins, what are the things that I see? What are the advantages that I can recognize? What are the disadvantages that I recognize? I would never take this one with live money. And that's why right there. You can't have this much indecision on a chart, guys, and feel like you have an advantage. But that's the beauty of simulator, right? I got to watch it play out, and I start talking through my head. What do I see? Why does this have a chance to win? Why does it have the probability to lose? And you're absolutely right, Rob. I know exactly what a camshaft is now. Because I asked. For you guys that don't know that story, when I was 25, I could, Steve. Let me show you something pretty cool. So this is a true story. For the sake of the story, because this is the market that I have in front of me, it's going the opposite direction. But when the S&P tanked a long time ago, I think it was the 90s, John Novak had a client that went short right here. And he was a big trader, and he was probably in it, I don't know, 1,000 contracts, whatever. And it came up to this divergence high. And he said, well, I'm going to go short again because that's a termination condition. And then he went short again. He said, no, this is a true story, Rob. And he said, there's no way this market could keep going up. I'm going to go short again. And then he went short again. And he went short again. And he said, there's no way this market's going down. And it's short again. And he went short again. And he went short again. And he kept adding to his losing position. Well, the S&P was in the biggest tank that it's ever had in its history. And when he was done with his opinions, he was down $12 million fighting the overall trend, fighting the momentum, moving his stops out of the way, trading with no stops, not having a reason. And this is a true story. And this gentleman, he had the money to lose. But that's $12 million that he lost in one day, guys. $12 million, and all it was an opinion. There's a difference between my indicators say and I think. And that's where, I told John Novak this the other day. The most dangerous word that I can ever use when I'm trading is I should. No, he's just a rich old man. I don't know, guys. That was 20 years ago. 25 years ago. This right here, the most dangerous two words in a trader's vocabulary are it should. It should go down from here. It should go down from here. It should. It should. It has to. It needs to. It must. And as soon as you guys replace it's gotta, that's a good one. As soon as you replace it should with my rules say, indicators say, what happens is you have this unbelievable clarity. You have this calmness. And Steve, I've revenge trade with the best of them because let's be honest, guys, I'm freaking brilliant. And I thought this support should hold, and I went long, and I went long again right here, and I said, there's no way this market's going down, and I went long again, and I added on to my position right there. And instead of just waiting for it to be right, instead of waiting for my rules to be met, instead of waiting for momentum and a clear path, guys, we're all subject. We're all subject to that little devil on our shoulders telling us, hey, Steve Diego, if you're in first, ladies are going to love you. Hey, Jen, if you can be the first one in and the last one out, Every man in London is going to want to be on your arm, right? And we put ourselves in this rock star category that's non-existent because if for some stupid reason I go short without a reason and I make $10,000, I must be the greatest trader ever. And there's no way that breaking my rules could possibly affect me long term. And this is where I go a little soapboxy, guys, is once you understand what it takes to get you into the market, once you understand your rules, it takes all the pressure off, right? And I'm gonna put Jen on a pedestal real quick. Some of the greatest pictures that I see in this room aren't trades at all, guys. Some of the greatest pictures that I see in this room are when you're watching the market and you're waiting for something and you just come through and you're like, oh my gosh, small's on wrong side of large. You're busy with the men in the UK, hang on. Atta girl. It's a term. No trade. Guys, this is the greatest picture that you can take. Is when you're so in line with what your rules are, when you're so adamant about your rules being met, that you'll take pictures of a market that isn't producing a rules-based trade, and you'll begin to take that picture, and you might just say, you know, in your favorite looks, you might open that up and maybe drop it in terminations, right? My rules aren't met, therefore I'm not even going to look for a trade. It's not a trade. But what happens is that you've committed this look to memory, that indecision look, and your brain is saying, wait a minute, we're not supposed to do anything when it looks like this. And then the flip side is your brain says, this is where we're supposed to be doing stuff. And that's why pictures are so important, guys. Look at the small chart. This is kind of cool, I think. Price, it's got to turn over and over until margin call, right, Steve? And Steve, there's I always say that people that get blown out in the market, we've all done it. We've all done it. If you haven't done it, it's because you haven't been in the market long enough. Everybody makes a catastrophic error at some point. Everybody just has this error that makes you go, oh my gosh, maybe I shouldn't be a day trader. True story. I think everybody's done it. I like this picture because I want to show you guys two things. When price reached the fib, your small chart looks like a seismograph as the two sides fight. And it had a pretty clean run until it hit the fib again, and now we're back in the indecision phase. Do you guys see that? So there's easy trades and there's hard trades. There's clear paths and there's no clear paths. And you got to learn these patterns. You've got to learn these patterns. And then once you learn these patterns, guys, then you don't have to guess or hope or wish anymore. All you got to do is do what you do. If you guys like to read, I'm a big reader. I was an English lit nerd. Emotion-free trading, guys. It'll take you an afternoon. Go curl up under a tree, get a little sunshine on your toes. This is a great one because the underlying message in the beginning is, are you acting in your own best interest? If you're jumping into trades where you don't have advantages, are you acting in your own best interest? If you're getting mad and adding contracts, are you acting in your own best interest? Jen, have an awesome afternoon. I do not disagree with your decision to not trade. Once we're done here, I'm shutting down charts and I'm not going to open them again until 9 a.m. tomorrow. FOMC can eat a bag. I won't even look at it. Won't even mess with it. It's fun to watch if you've never seen it. If you've never watched the market react to FOMC, open up the S&P or the NASDAQ and have fun. Grab some popcorn. I would encourage you to not try to trade it, though. Or trade it. Do whatever you want. I don't give trading advice. Good class today. Are there any questions before we call it? And for those of you that are feeling overwhelmed, I promise every day it gets better. And for those of you that aren't sure if you can do it, I assure you, you can. It just takes a little practice, guys. It just takes a little time and a little bit of trust that comes through repetition, and anybody can do this. Anybody can do this. It's like a video game when you were 12. Once you learn the patterns, you find the successes. So appreciate that, Steve Diego. Great questions coming out of you. I can't tell you how much I appreciate them. I want every question. I want all the how comes and all the why nots and all the it shoulds versus it says.